and then there is also another supply zone all the way up here at this extreme high right here, right? And yeah, there's basically two supply zones right here. So the reason why I marked up these supply zones is because this is what you call your rally base drop. Rally base drop, right? And it basically tells us that this is the initiation of this push phase, right? These sellers entering into the market. You can see huge bearish candlestick right here, which pretty much tells us that there's some sort of smart money or financial institution involvement right here, right? They entered for a bulk amount of sell orders within these two areas here. So that is my supply zone. And I basically draw my supply zone by marking up the entire range before the bearish liquidity or the supply enter into the market. So it will be this entire range right here. But sometimes what I like to do is to, you know, refine it to the candle right before the bearish liquidity, right before the supply actually happens. So in this case, I'll refine it to like this candle, right? So the reason why I like to do this is because I want to keep my zone nice and tight instead of having like this entire consolidation right here, nice and tight just like this, and you will most likely do. And right now, the thing about price is that even though price is in an uptrend, and by right, we should be entering for a buy because we want to trade the trend, right? But right now, price is actually in a supply zone, right? So that's the key thing to note. That's a big red flag. And when price actually enter into the supply zone, my next step would be to, you know, go down to my smaller time frames. This is where I look for my entry, look for my flip zones. And in this case, I'll most likely be going down to the 1 hour time frame, right? Once I go down to the 1 hour time frame, I'll be marking my structure up once again, and I can see there is a break of structure right here because the last time price actually went up there, it actually created another higher high. So you can see this is the high right here, and this is the higher low, and then right now price created another high, and right now price is potentially pulling back after creating this higher high. So at this point of time, I'm marking up my break of structure. I'm also going to mark up where's my swing high and my swing low. So this is my swing high right here, and then there's a swing low right here, right? So there's a swing low right here because this is where price actually, you know, pulls up, retrace, and then go up even further. So there's a very strong, or rather not strong, but like rather a weak swing low right here. At this point of time, we are looking for our flip zones, right? In order for this to confirm to us that, you know, price is going to go down right now because this supply zone is going to do its job, right? This higher time frame supply zone is going to do its job. Sellers are going to enter into the market. Here's what you need to see. You need to see price actually, you know, react to this demand zone right here, and it fails, right? It has to create that failed reaction, and then after it created that failed reaction, it has to break structure, which is breaking below this low, creating your market shift. That confirm to us and tell us that price is going to reverse from an uptrend to a downtrend, and only then you can look to enter for a sell position. So in this case, what do we have right here? What we have right here was that there was a demand zone right here, right? Obviously, there's going to be a demand zone right there because this is your pivot zone where price actually, you know, goes up, come down, pivot, and then goes up, right? This is where demand step into the market, and this candle actually initiate that demand. So this is your demand zone. And right now, price seems to be creating that failed reaction. So what happened right here is that price comes down into the demand zone and it reacted from the demand zone. Remember, the reaction is very important. You need to see that reaction because it confirmed to us that this demand zone is working. But whether it does its job, it's another question. And in this scenario right here, if this demand zone were to do its job, what price is going to do is that it's going to continue going up even higher, creating that higher high and higher low, and just continue going to the moon. But in this case, it did not have enough momentum to do that. It did not have enough fuel. So what happened is that after price actually reacted from the demand zone, sellers stepped back into the market and push the price down, creating your market shift. And it actually broke through the last low right here. When it does that, we have an officially a market shift right here, right? A shift of structure. And right now, this could be like the first sign that tells us that the order flow is about to shift from bullish to bearish. So this is where supply actually stepped into the market after it created a failed reaction from this demand zone. So this is your supply zone, right? And this is also known as your flip zone, right? Because once again, this is where demand has flipped to supply and created that failed reaction, right? So ideally, I would mark up like the candle right before the supply step into the market like this. But what you can also do is to mark up like the entire range. This entire range also constitute as a flip zone, right? But for me, I like to refine it to like just this candle right here, right? But obviously, if you refine it to like this as well, it's also quite valid. So this entire area will be a flip zone. So in that case, I'm pretty much waiting for price to actually tap into that flip zone, and that is when I can potentially look for my entry somewhere within this flip zone. So let's just drag that out right there. And potentially I could be placing like some sort of sell order at this flip zone, and now my stop loss will be above this flip zone, somewhere right around there. And then my take profit will potentially be where's the next demand zone, right? Where's the next swing low? And this could potentially be the next swing low right there. So this would be like a very easy trade setup right there. And you can see, let's just observe what price does, right? Because obviously I feel like this stop loss is way too big, right? And if price actually like, you know, goes up there, tap into the flip zone and just mitigate it, then obviously my stop loss wouldn't be so wide. It doesn't make sense for my stop loss to be that wide. In that case, my stop loss will probably be just right above this area right here, and my risk to reward ratio will be much more higher. So in this case, just observe what price does. Okay, you can see price taps into that flip zone. That's a good thing, guys. Price taps into the flip zone. And usually, sometimes, just for you to take note, price can either go into the 50%, which means like the halfway through inside this flip zone, and then go, or sometimes it can even touch the flip zone and just go. There's never like a rule that says that, okay, you should enter immediately after price tap into the flip zone or tap into the 50% of the flip zone. It's all depends on you, right? So test it out and see which one works for you, and then stick to using that one. So in this case, price has entered into like the 50% of the flip zone, and that is when I can potentially have entered for the trade setup manually. I always prefer to enter my trades manually after getting some sort of confirmation. So I enter like some sort, like 50% right here. You can see bearish liquidity started entering into the market. Supply have officially stepped into the market, and this flip zone is going to do its job, right? So somewhere right around here, this 50%, I've already entered into the trade. My stop loss will be probably just right above this flip zone, and this would potentially be a 1:3 risk to reward ratio. You can just observe how price does. Boom, smash your take profit. As simple as that. Got out of the trade. Happy days. Go and celebrate with champagne or something. Now, after we got out of this trade, observe what price is doing right now. Price has came back down here to this swing low, right? And this swing low is usually like a point for smart money to actually grab more liquidity to continue this down move. So most likely it's gonna like reverse at this area right here, creating that another lower high and then go down even further, right? It's literally that area for smart money to grab more liquidity. So at this area right here, there is also your demand zone right here. So once again, there is your demand zone right there. And in this area, we want to see whether price actually respect this demand zone or not. And in that case, I'm waiting to see whether there is a failed reaction right here, or price actually react to this demand zone and just continue going back up, right? So let's look at what price does, and you can see price comes down, boom, there you have it, your failed reaction. Once again, price actually reacted to the demand zone, right? A very valid reaction, but like I said, it was not enough to continue going up, right? It did not have enough momentum. It did not have enough buyers to continue pushing the price up. So over here, this is what I call the failed reaction, right? Failed reaction happened right here, so you can pretty much draw your flip zone within this range right here. So this entire range would be your flip zone, right? Flip zone right there, and then price also created the market shift right here already, where price actually pierced past the last low. You can see price is going to go down, and right now we could potentially look to enter for a sell position once again when price actually, you know, enter back into the flip zone. You can see price step into the flip zone right there. Price step into the 50% of the flip zone once again. Pretty much like quite similar to this. We are inside the trade and price just collapse, right? Price just collapse and go down. And yeah, happy days. This is essentially how you trade the flip zones in a bearish downtrend. So this is a pretty good example of demand to supply flip zone, where supply has pretty much overpowered demand and causing the entire order flow to shift from bearish to bullish. Now, what does it look like in an uptrend? What does a supply to demand flip zone actually looks like? And that is what we're going to explore right now. So over here, once again, price is coming down here, crashing down, and I can see price is approaching this demand zone that we have earlier. The reason why I draw this demand zone is because this is actually your drop, base, rally, right? So this consolidation right here is happened right before the demand step into the market and push the price up. Right, so this is pretty much a valid demand zone. So at this point of time, price is approaching this demand zone and we don't really want to do anything, right? It's too late for you to enter for a sell already, even though price in a downtrend, because price is approaching a demand zone where smart money is potentially going to enter buy orders in bulk and potentially push the price up. And look at what price does. Price steps into the demand zone and boom, you can see smart money enter into the market and create a V-shaped reaction, right? Where price created this V-shaped reaction, this is most likely involvement of the big financial institutions, right? And usually happen after a liquidity sweep. So there was available liquidity below these lows right here. So there was a liquidity sweep right there, right? Sweep the liquidity right there. And at this point of time, like I said, I want to mark up my market structure, my swing lows and my swing highs. So this is the last swing high right here, or this is the last lower high. So at this point of time, there is also a supply zone right here, right? There's a supply zone right here that actually resulted, or rather caused price to move down to this demand zone. So at this point of time, we want to see whether this supply zone does its job or not, right? So we tap into that supply zone, and like I said, if this supply zone were to do its job, it's going to continue creating that lower high and lower low and lower high and lower low. Then at that point of time, there's no point of us thinking that price is going to reverse, right? So we'll see. You can see price is mitigating this supply zone, starting to head back down. But look at what happened, right? Instead of creating that lower low, what price actually did is that it created that higher low. And you can see this low right here is higher than this low. So this pretty much confirmed to us that this is your flip zone, right? This is where supply has officially flipped to your demand, right? So this is your supply to demand flip zone. And for this to be a valid flip zone, like I said, we want to see that market shift. We want to see price actually pierce past this last lower high, confirming to us that there is a shift of structure, confirming to us that this bearish order flow is about to end, and right now price is going to go to the moon. And that is what we want to see. You can see, okay, market shift happened right here, and right now I could potentially enter for my buy position, and price actually taps into the demand zone, and I could potentially, you know, have my take profit somewhere right up here at this supply zone, right, at this next supply zone right here, right? A very quick scalp or whatsoever, not really quick actually, but you can see price tap into that flip zone right here. Once again, boom, tap into it. Actually, you already tap into it right here, right? You already tap into the flip zone right here. It taps into it. You can see when it taps into that flip zone, a lot of liquidity actually enter into the market, which can be seen by these huge imbalances. You can see smart money enter into the market. Boom, this is where the demand has overpowered the supply, and right now we are just about to go to the moon. And you can see price just about to, you know, just about to do its thing and just go up there, right? And yeah, potentially go up to this supply zone that we have right here, and just steps into it, and boom, we get our take profit hit, and life goes on, right? Very, very simple. And the thing about this strategy is that it seems quite simple, but the hard part is waiting for that high probability trade setup, waiting for that market shift to occur, waiting for price to get back to the flip zone after the market shift occur. That is the difficult part. It's all about patience. Patience is the name of the game. Now, I'll be very honest with you. Even though this is a high win rate trading strategy, the truth is no strategy works 100% of the time, right? This strategy will not work all the time. Sometimes price will just not respect the flip zone. It will not respect to the flip zone. It will go to the extreme zone and then go. Or it might not even touch the flip zone and then go, right? So it really comes down to you asking yourself this question here. When in doubt, just ask yourself, has the flip zone swept liquidity? Right? Because the market move based on liquidity. If smart money want to enter for a buy position, they need a large amount of sell orders. And they can only get that from you guys, from your stop loss, from the liquidity inside the market. So ask yourself this question, has the flip zone swept liquidity? If yes, enter on the flip zone. If no, wait for a liquidity sweep to happen first and enter on either the extreme supply and demand zone or the next supply and demand zone after getting extra confirmation. This is what I mean. So over here, this is a pretty similar example, so I'm not going to go through the entire thing again. But what happened right here is that price was in a bearish downtrend, bearish order flow, and price has just came back down to this strong demand zone that we have right here. So we have our supply zone right here, and you can see price created that flip zone after price reacted at this demand zone, right? It just reacted at this demand zone, come up to this supply zone, and then instead of continue going down, it actually created that higher low, right? So this low higher than this low right here, and this is your flip zone. So at this point of time, I can just mark up my flip zone right here. Right, this entire thing is a flip zone. So look at what price does. Price goes up, price come into the flip zone. Potentially you enter for a buy here immediately after price come into the flip zone, and you place your stop loss below this flip zone, and bam, you just lost your trade. You just lost your trade because you don't really know what you are doing. Like, you're just thinking of trading in terms of like a very surface level knowledge. You don't really have a deep understanding of liquidity and the market in general. So what happened right here is that what you did wrong was that you did not wait for liquidity. Like I said just now, this flip zone strategy is not going to work all the time. You're not going to get that perfect flip zone reaction every single time. The market is random, these patterns are random, so what you can potentially do is to react to what the market is doing. So in this example right here, like I said, you are asking yourself, as price enters into the flip zone, whether price has already swept liquidity, whether this flip zone has already swept any sort of liquidity. And if you look towards the left, where is all the liquidity points? It's right here, right? You can see as price pivot right here, there's going to be available liquidity below these lows right here, because maybe buyers are entering right here, they're going to be placing their stop loss below these lows right here, below this higher low. So there's going to be a ton of liquidity being built up above, below these lows right here. And in addition to that, where else is the liquidity? There's a trend line right here, right? Retail traders, they'll to place their trend line. When they place that trend line right there, guess what? They're going to be placing their stop losses below this trend line right here when they enter for a buy after price bounce off the trend line, after price bounce off the trend line. And in that case, all the stop loss below this trend line right here, all of these are available liquidity. So there's liquidity below all this trend line right here, lots of liquidity. There's also liquidity below this low right here. So in this example right here, price has not swept the liquidity whatsoever. So what we could potentially do is to wait for the liquidity sweep to happen. Wait for price to sweep all this available liquidity, and then we enter for the trade. So once again, if you look at the guide that I have right here, so if it has not swept liquidity, right, you want to enter either on the extreme supply or demand zone or the next supply or demand zone. So in this scenario right here, this will be the extreme zone, right? This will be like the most extreme demand zone that we have right here, right? And right now, we could potentially expect price to sweep the liquidity first below all these lows right there. And when it does that, it's going to tap into the demand zone, right? This extreme demand zone. And only then, that is when you can potentially look for your buy setup somewhere right within this demand zone, right? And if you look for that, you can see price just skyrocket, right? Huge amount of money just entered into the market. Huge demand have just officially stepped into the market after price has swept all the available liquidity right here, or rather after the smart money have swept all the liquidity. And what happened if, you know, you failed to enter at this demand zone right here, then there is the next supply and demand zone that you can actually look to enter for, right? You can see as price actually started retracing right here, right? And you can actually draw another demand zone right here. And next time price actually tap into the demand zone, you can easily enter for another buy position and just continue this, so on and so forth, right? So that is what I mean when I say that if the flip zone has not swept liquidity whatsoever, then you want to enter on the extreme supply or demand zone or the next supply and demand zone after getting the extra confirmation, which only comes in a form of, you know, signs that tell you that smart money have entered into the market. Once again, another example right here. So right now, price has came back down to this swing low that we have right here. And right now, once again, this is your demand zone, right? This entire thing is your demand zone. And you can see price has actually reacted to the demand zone and created that fake reaction right here, where price actually goes up, create that lower high, and just goes down, right? So this could potentially be your flip zone, right? And like I said, you want to ask yourself, has the flip zone swept liquidity? If yes, then potentially you could enter where price step into the flip zone. But in this case, there was no liquidity being swept whatsoever, right? So we could potentially expect price to completely disregard its flip zone, come into like this extreme supply zone right here, and that is when you can potentially look for your trade setup, right? But once again, always wait and react to what the market is doing, and you can see price just goes down and boom, completely disregarded in this flip zone. And where is it going to go next? This entire supply zone that we have right here, right? This entire supply zone that we have, this range right here, boom, that is when you can potentially look for your entry. So let's say you actually wanted to enter for a sell position at this flip zone, right? And you did not get the entry because price just completely mitigated it. Or you actually enter into the trade, but you place your stop loss above this flip zone and now you got stopped out. In that case, suck it up. Move on to the next trade, right? Just get rid of this and look for your next opportunity. Your next opportunity window will be at the extreme supply or demand zone. So this is the extreme supply zone. So we are going to see whether price respects this supply zone. And if it does, I want to get involved for a sell position and place my stop loss above this supply and potentially take it at a next take profit, next demand zone that we have right here or whatsoever. And you can see right here, tap into the supply zone, boom, comes down to this demand zone right here before actually heading up and boom, smashing our take profit. So this is exactly what I mean when I say that you need to be very reactive. You need to be very flexible and adapt to what the market is doing. And always make sure that you are being very careful. So go out there, play with this trading strategy, practice, backtest, and see whether it works or not before you try it out on your live account. And if you can combine this flip zone strategy with market structure, trust me, it's gonna be insane, right? Let's just say it's gonna be crazy. This is really the secret sauce that's allowed me to follow the smart money footprints. Don't worry, I'm not going to charge you $997. I'm going to give it to you for completely free. So firstly, what are order blocks? Order blocks are basically areas on price chart where large market participants like banks and financial institutions place a substantial amount of buy or sell orders. That is why they are called order blocks. It's literally in the name, guys. Now, order blocks and supply and demand zones, they are very similar with just a few differences. The first difference is that order blocks are much more effective than supply and demand zones. Because after all, the point of order blocks is to really show us where smart money has entered into the market and where they are most likely going to enter again. The second difference is different rules are used when identifying valid order blocks. Now, for a zone to be considered as an order block, it needs to meet 4 criteria, which I'm going to show you later. Now, the trick to identifying order blocks is to look for sharp and substantial upward movement or downward movement. So in this case, you can see we got a sharp and substantial upward movement right here where price is going up very aggressively, just like this. In that case, you just want to look for the candle right before this sharp and substantial upward movement. And damn, that's a mouthful. So this is the candle right here. So in this case, you just need to draw a box marking the top, the high, and the low of this particular candle, and this creates your order block. And then in a bearish scenario, you should be looking for a sharp and substantial downward movement. And once again, you look for the last candle, which created this sharp downward movement, this aggressively down move, if that's even a word. And you just find the candle right there. And that is where you basically drop the order block. It's really not rocket science, guys. It's just you look for that one little candle before a sharp and substantial movement, and you just draw a box marking the high and the low of that pivot candle, and there you have your little beautiful order block. Like I mentioned just now, in order for a zone to be considered as an order block, it needs to meet 4 criteria, right? It must meet every single one of these 4 criteria. If it does not meet a single one of them, it is not an order block. It could just be like a normal supply and demand zone. So the first rule is that the pivot candle must close below or above the previous candle. So after identifying a sharp and substantial upward movement just like this, we are able to identify that this is actually the pivot candle where we can actually draw the order block. Now, knowing that this is the pivot candle, you need to ensure that this pivot candle close below the previous candle, because this indicates that institutional buyers are stepping in, absorbing sell orders and preparing to push price higher. So looking at these 2 examples that we have right here, this pivot candle did close below the last candle, but this pivot candle did not manage to close below the previous candle, since this previous candle went all the way down here, right? So this pivot candle actually closed up here, so it's not really considered as a valid order block in this case. The second criteria is that the order block must cause imbalance. What that means is that there must be a gap. How do you know there's a gap there? You basically look at the high of the pivot candle, and then you look at the low of the next candle, in this case right here, and you can see this creates like a little gap that we have right here. What this gap tells us is that At this point of time, smart money have entered into the market and it has managed to push price aggressively up so much that it left a gap behind, telling us there was a large amount of demand stepping into the market at this point of time. And then in this example right here, there was actually no gap, because if you look at the high of this pivot candle and then you look at the low of the next candle, in this case, it's pretty much at the exact same price, right? So since there is no gap right here, this order block cannot be considered as valid, therefore making it an invalid order block. The third criteria is that an order block must be unmitigated. It must be fresh. That means price cannot actually tap into it. If it tap into it, then it has already been mitigated. And what this means is that the orders yet to be filled within this order block itself, it has already been filled by the smart money. You must understand why an order block is formed. At this point of time, this is where smart money have entered for a large amount of buy orders, right? So knowing this creates an order block. This means that at some point of time, price is most likely going to come back into this order block, right? Fill up the remaining buy orders yet to be filled before going up even further. Now, in this case, since it has already been mitigated by this particular candle right here, what this tells us is that the orders yet to be filled within this order block has been filled by the smart money, right? So right now, price is most likely going to go up there and is very less likely going to come down and mitigate it. However, there is still a chance that price could come down here and mitigate it in the future, but it's just less likely since it has already been mitigated. The strongest order blocks are always those that is fresh, new and unmitigated. The fourth criteria is that it must lead to a break of structure. So in this case, this order block right here, it led to this break of structure, making this a valid order block. And then this one right here led to this break of structure, making this a valid order block. And then this one led to this market shift. Once again, is also a break of structure, but it's just like a reversal in the structure, and making this still a valid order block. And then this is also going to be a valid order block because it did lead to a break of structure. So those are the 4 rules of order blocks, right? You must ensure that the point of interest or the zone must meet all 4 of these criteria for it to actually be considered as a real order block. If it does not meet a single one of them, it is not an order block. It could just be a supply and demand zone or just an ordinary stupid zone that is not going to work. So now let's apply what we have learned and really learn how to differentiate between valid order blocks and invalid order blocks. So this order block right here, right, we saw that there was a sharp and substantial upward movement. Cool. And then we know that this is the pivot candle that led to this movement. And did this pivot candle actually close below the previous candlestick low? Yes, it did. Cool. Is this unmitigated? Yes, it is, right? And was there some form of gap? Yes, there is. There's a gap between the high of this candle and the low of the next candle. Okay, cool. There is unmitigated, it caused imbalance, there is a gap, and it closed below the previous candlestick low. And it led to a break of structure. That's the last criteria. It did, right? It did lead to a break of structure. In this case, this tells us that this is a valid order block. So we can expect price to come down here at some point of time, mitigate it before going up even further. And then let's look at this next zone right here. Do we have a sharp and substantial upward movement? Yes, we do, right? But look at this pivot candle. This pivot candle did not close below the previous candlestick low, which is right down here. In this case, this is an invalid order block. And then let's look at this next zone right here. In this case, sharp and substantial upward movement, but the thing is there is no gap, alright? You can see there is no gap. This is the high of this pivot candle and the low is like all the way down here. There is no gap. That is why there is no imbalance whatsoever, and this zone has also been mitigated, right? Which means smart money have already used this zone. In that case, we can just ignore about this zone right here. And then the last zone that we have right here, okay, sharp and substantial upward movement, cool. Is it unmitigated? Yes, it is. Did it cause imbalance? Yes, there's some form of, there's a small little gap right here. The marker that I'm drawing right here is way too big, but yes, there's a little bit of gap right there. And then this did close below the last candlestick low, making this a valid order block. So then now that you understood theory, let's go on to the charts and apply what we have learned so far and really ensure that you get a deep understanding of the order blocks before you actually go and apply it onto your real account with your hard-earned money. Now, how do you actually trade order blocks? Where do you enter and where do you exit? That's what we're going to cover next, right? I'm going to show you my entire order block strategy from top to bottom. First thing you must understand is that there are two ways to actually enter for a trade using this order block strategy. The first way is called a risk entry method, and then the second way is called the confirmation entry method. I'm going to show you the pros and cons of each, and then based on this, you can decide which works best for you and then pick that one. Right, so firstly, let's talk about the risk entry method. So based on what we have right here, let me just identify the order blocks. There's perhaps one like right here. You can see there's a large amount of imbalance right here, and then there is a gap, it's unmitigated, blah blah blah. We know that, okay, cool, there is an order block right there, okay, and then this is the pivot candle that caused this sharp and substantial downward movement. And since price has already came all the way down here, yes, there is still a chance that price could potentially move up there, mitigate it, and then go down even further. But let's look at what we have right here, because we have another order block. Right, so there is another order block right there, because once again, there is your sharp and substantial downward movement. Okay, that is your gap, and then this also led to a break of structure to the downside that we have right here, where price, I don't know why I just said that, where price has just broke past the last swing low. Right, so that is your bearish break of structure to the downside. Okay, so now you can see we got these two order blocks right here. The question you guys are gonna ask me is, okay, cool, Brad, which order block is price gonna go? I have no idea, alright? I don't have a crystal ball. I'm not a fortune teller. I have no idea. Okay, so if you are using the risk entry method, that means you are most likely going to be placing a sell order at the edge of the zone itself. That means when price eventually go up there, touches the zone, you'll be tapped into a sell position automatically by your broker, and then you are praying for the best, right? You're praying that, you know, price will not hit your stop loss and price will just go in your way. You're praying that this order block will work. So that's the risk entry method. All right, basically placing a sell or buy limit order at the zone itself, and then once price step into the zone, your broker get you into the trade. The bad thing about this risk entry method is that you don't have extra confirmation, right? That means sometimes price can just blow right past your order block. In that case, you have lost this trade right here because you didn't actually wait for confirmation. Okay, but we are talking about that later. For now, let's say you actually decided to go for a risk entry method and you place your sell order at the edge of this order block right here, and you place your stop loss above the order block itself. And then for a take profit, you can place your take profit at the next structure, be it the next swing low, right? You always look towards the left. So if I look towards the left right here, I'll see that based on the structure, this is the last swing low that we have right here, because this is the last time price actually pull back all the way down here and then goes all the way up there and break structure right there. So this is the last swing low. So you can potentially target that last swing low that we have right there. Or you can even target the opposing order block, right? The next order block, which could potentially be this area right here. This is the next order block, right? So all in all, this look exactly the same. So let's say you decide to go for a risk entry right there. Let's see how this play out. Okay, cool. Right here, you got tap into the trade. Let's just continue to see what price does. Okay, you can see supply stand to the market and bam, you hit take profit. Congratulations. Now here comes the brokies. Oh, Brad, you could have just cherry picked this. You know, like this is like a perfect zone. You just bar replay. Anybody can do it in bar replay. I agree with you. That is why I don't really like to use this risk entry, because for every one order block that actually works, there is like 5 other order blocks that don't actually work. That's just the nature of the irrational and unpredictable market. Before I show you the next method, let me just show you more examples on this risk entry method. So let's look at what happens next. Okay, price just blow right past that, and then we are looking for our new order block. Okay, price has stepped into this new little, okay, this is not really order block, this is more of like a supply zone because it did not meet all 4 of these criteria, right? You know, there was no gap, it's also been mitigated whatsoever, so this is just an ordinary supply zone, right? But I can see price step into this. Okay, came down here. Okay, cool. Now we can draw our new order block right here, right? This is the pivot candle that led to this sharp and substantial downward movement that we have right here. Okay, so this is our new order block, and let's say we put our risk entry right there once again, right? We are entering for a sell at the edge of this zone. And then let's just see what price does. Does it actually go up there? Nope. I don't think it has went all the way up there. Okay, so let's just look for another order block. Okay, there's another order block right there. Okay, and then let's place our risk entry right there. Okay, let's just, once again, this is what you guys do, right? Risk entry. Boom, you are tapped into the trade right here. Nice. At this point of time, I will target the previous swing low. Once again, where is the previous swing low? Okay, so this will be the previous swing low. You always look towards the left, right? So this is the previous swing low. Target just right there. And then let's just see whether we hit take profit right there. Okay, it came down here. Okay, I believe we are going very near the take profit. Right. Bam, you hit your take profit right there. Congratulations, you just won 2 trades out of, I don't know, 10. So as exciting as this risk entry are, sometimes they just don't really work, right? Because sometimes price can just tap into this order block and then just blow right past it and then just reverse and hit up and just go against you. In that case, you have lost this trade, right? So if you want to get a higher win rate, that is where you need to deploy what I call a confirmation entry. So unlike the risk entry, where you're entering straight away after price tap into your order block, on a confirmation entry, you are waiting for extra confirmation after price has stepped into the order block. And if you use this method, you will get a much higher win rate because you will actually be waiting for confirmation that shows you, that confirms to you that the order block is actually working and it's not just like a fake useless order block that price is just gonna blow right past it. Step 1 is to draw your order blocks, obviously. So over here, we saw that there was a sharp and substantial downward movement just like this. So in this case, we can actually draw our order block at a pivot candle, right? So for this right here is a little bit weird, right? Because it's a very large area. So I'll just mark this entire area as my pivot candle right here from the high to the low of this pivot candle. So now that we got our order block right here, right now we are just waiting for price to come back up here. Now for confirmation entry, we are not going to be entering straight away when price step into the zone. We are going to be waiting for the structure to shift once price step into the zone, right, to get the extra confirmation. What I mean is that I want to see this little pullback to be over. Basically, right now price has turned bullish to facilitate the pullback. So what I want to see on a 15-minute time frame is for this little bullish uptrend, this little pullback, to be over, right? So in that case, I need to look for some form of market shift, right? So let's just continue to look at price pulling back. All right, you can see price pull back and then finally tap into our order block that we have right here. So based on this, this was the last break of structure to the upside, right? Since this is the last break of structure to the upside, we know that this one right here is the lowest point that led to this break of structure, making this the last swing low. That means if price comes down there and break past this last swing low, that tells us that this pullback is over and right now price is turning bearish and is aligned with the higher time frame trend, and right now price is about to go down even further, right, to continue the bearish order flow. So in this case, like I said, this is what confirmation entry is all about. It's waiting for the extra confirmation that tell you that structure has shifted before you actually enter for a sell. So at this point of time, I'm still waiting because it has not given me a valid market shift yet, right? Like I said, if you are playing the risk entry, you would have gotten in right here. But in this case, we are looking for the confirmation entry. So I'm just waiting, still waiting until price broke structure. By the way, this is more for swing traders, okay? So right there, this is where we officially got a market shift right now, right? And this tells us that, cool, right now, this pullback is over. This bullish internal structure has officially shifted bearish, and the internal structure, the lower time frame trend, is aligned with the higher time frame trend, which is bearish. Now everything start to click like clockwork, baby. All right, so this is where you got a market shift right here. Okay, cool. Now, this is where we start looking for our entry. Now, to refine my entry, what I like to do is to look for more order blocks that is within the entry time frame, which in this case, since I'm entering the trade on a 15-minute time frame, I want to look for some form of order block within the 15-minute time frame itself. Right, so based on this, I can spot that, okay, there is a little order block right there. Okay, there's one order block right there. And then perhaps there's another one, I'll say right here, but this one has been mitigated, so it'll be this one right here. Okay, this one right here. Once again, sharp and substantial downward movement right here, guys. Let me just draw it out for you guys to see. Sharp and substantial downward movement. Sharp and substantial downward movement. And you can see this one right here, it also did lead to a break of structure. Okay, and there was a gap, so on and so forth. Pretty much fulfill all 4 criteria. So now, like I said, I don't actually know which zone price is gonna respect, so I'm just gonna wait and see, right? So okay, price eventually come up into this zone right here. Okay, there's a chance that at this zone is gonna go, okay, but we still wait for extra confirmation. Okay, you can see price actually ended up going even further, came all the way up here to our extreme order block that we have right here, and somewhere along the lines it just blow right past it. Okay, tap into this order block right here. So this one we can just completely get rid of. Now, at this point of time, this is where you can actually enter for a sell right here at the edge of this zone. And if you do actually enter for a sell right here at this order block, if you think about it, it's still some form of risk entry because you are still not waiting for the extra confirmation, right? So for it to be really a confirmation entry, in this case, I will go down to the lower time frame, the 5-minute time frame, and wait for this little pullback to be oval, right? This bullish pullback once again to be oval, and then that is when you can potentially get your confirmation entry in, right there, ladies and gents. You look at this internal structure on the 5-minute time frame. This is the last internal higher low. This is more for advanced traders already. We got the market shift to the downside, which tells us that right now price is officially shifted bearish, and that is where you can enter for your sell position right there. Okay, so you can enter for a sell right here, place your stop loss above this order block itself, and then like I said, you can take profit at the next structural or the next order block that we have right down here. Okay, so yeah, this is potentially what a confirmation entry is about. It's really waiting for the extra confirmation before you pull the trigger, right? If you want to even go like more extreme, right, more advanced, instead of entering right here, what you could have potentially done is to wait for price to pull back after this market shift into this area right here, right? This entire demand zone right there, and then you enter at the edge of this demand zone. And in this case, you can see this is a 1:6 risk to reward ratio trade, right? It's a very refined entry. Okay, but yeah, like I said, this is more advanced stuff, right? And right now, if you are a beginner, take things slow, right? Master the risk entry first, then go and master the confirmation entry, and then find out what works best for you. And then based on the data that you have collected, go and stick to that particular method, whether that is risk entry and confirmation entry. For myself, based on my own experience, I found that the confirmation entry just works so much better for me, because I found that when I use the risk entry, sometimes the order block just blow right past it, and I just take a bunch of losses that I would have taken if I just look, or rather wait for the confirmation in the first place. Now, to be honest, order blocks itself is powerful, but if you want to make it even more powerful, you need to combine it with liquidity concepts. And if you can combine these two concepts, it's like having X-ray vision on the market. You can actually see where smart money enter into the market and where they are most likely going to enter. And then you can kind of predict, and you can just do some witchcraft on the market. Inducements are basically traps for retail traders where smart money entices market participants to enter for trades and transact at certain levels. In this way, smart money is able to generate a large amount of liquidity in order to fuel their large positions. They basically entice retail traders by using obvious chart patterns like double top and double bottom, or support and resistance levels. Basically all these retail trading concepts, baiting them into entering the trade early. For example, when a retail trader see a double bottom chart pattern just like this form at a support level, they are going to enter for a buy, thinking that price will go up. And as a result, they will most likely be placing the stop loss below the support level or below the double bottom just like this. And when this happens, this actually generates liquidity. Because if the retail traders who entered for a buy right here get stopped out, guess what? They have to sell the position. On the other hand, this double bottom chart pattern also induces the retail traders who might be bearish and they want to enter for a sell when price actually break out of this support level right here. In this case, they will most likely be placing a sell stop order below the support level or below the double bottom, once again generating liquidity below these lows right here. Now, once all the retail noobs have been induced to enter for their buy orders and their sell stop orders, smart money will then manipulate price by pushing it down to sweep the available liquidity below these lows, and when this happens, this will generate enough liquidity to fuel their large buy orders, and this causes price to skyrocket to the upside. This is exactly why you keep on getting stopped out only to see price go in your way. It's simply because smart money is just getting some liquidity from you. Now let's look at other types of inducements. So in this bearish scenario right here, we have price pulling back to this supply zone that we have right here. And the minute price actually mitigate this supply zone, it formed a double top. Once again, when retail traders see this double top chart pattern, they're going to think that, you know what, I'm going to enter for a sell right here and place my stop loss above this double top. only for price to later go on there, sweep the available liquidity above this double top before going back down, right? It's pretty much the same concept right here. On the other hand, there will also be retail traders who want to enter for a buy after price actually break out of this resistance level or this double top. In that case, they'll be placing their buy stop orders right here, only for smart money to manipulate price up there and psych them out of their position by causing price to reverse and head in the other direction after grabbing liquidity. So yeah, this is exactly why chart patterns don't work that well, right? So if you're still trading chart patterns, it's time to stop, alright? On the other hand, right here, we also got a strong low and strong high example. Now, the other type of inducements is also created when there is a strong low or strong high. In this case, we got price pulling back to the last swing low, right? And what happened was that the internal structure turned bearish to facilitate that pullback. So we could expect the internal structure to be bearish. And when we see price breaking past the last internal lower high, that tells us that there is a market shift, there is a shift in structure, and price is gonna head up, right? Wrong. Because what can potentially happen is that price could just go up there, sweep the available liquidity above this swing high right there before coming down there even further, sweeping the available liquidity below this swing low as well, right? So a lot of retail traders, they will most likely enter for a buy after this strong low is formed, but then later price come down and sweep more liquidity before actually going to the upside. Or in this bear scenario right here, where a strong high is formed after price actually break past that strong internal higher low, right? When this happens, remember there is available liquidity above this swing high. Once again, because all the retail traders who enter for a sell here, they will be placing their stop loss above this swing high, only for smart money to come up there, sweep the available liquidity above this swing high and causing price to go in that other direction. So my tip is always look out for inducements when price is approaching a point of interest, like an order block, a supply and demand zone, or a flip zone, or even a sweep zone, right? Any sort of point of interest. Because when price actually approach those zones, that is where so many retail traders, they will be impatient and they will enter too early just for price to come down and sweep the available liquidity before the actual move actually happens. So always wait for liquidity sweep before entering. And remember, if you cannot spot the liquidity, then you are most likely the liquidity. Instead of me yapping, why not I just go onto the charts and show you how it's done, alright? So right now we got GU on a 15-minute time frame. The first thing you want to do is to actually map out your structure. So over here we got a break of structure to the downside, and this tells us that this is that last 15-minute swing high. Okay, so I'll just put this as the 15-minute strong swing high that led to this break of structure. And then over here we got price pull back a little bit before going down even further. And this could constitute as your internal break of structure. Okay, so when we got a market shift right here where price actually broke past that last internal lower high, this does not signal that price has officially shifted bullish. This just signals that price is potentially turning bullish to facilitate that pullback back to that last swing high before continuing down, going even further and continue creating that lower high, lower low dynamic. So always try to understand what's the objective of price, right? What is price trying to do? So now we have figured out that, okay, price has officially turned bullish to facilitate that pullback. So on the internal structure, we can expect price to create higher highs, higher lows, until price actually break past that last higher low, that last internal higher low, give us the market shift, a shift in structure, then that confirm to us that price is shifting bearish and we can look for our sell position to trade with that swing structure. And then the next step is to actually mark up your point of interest. Okay, so over here we got our extreme supply zone right here that led to this break of structure, and then there is also another supply zone right here. Okay, there's also another supply zone right here. This is more of an order block, right? But I'll just label this as a supply zone right there. Let me just mark this up right there, make it a little bit more cleaner. Okay, so right now we have our 2 point of interest. We know that price is turning bullish to facilitate that pullback. The objective of price is that it wants to mitigate this, either one of this supply zone, right? Fill up the remaining sell orders before heading back to the downside, right? So in this case, let's just continue to play price forward and just wait for price to mitigate that point of interest. So until price actually does that, we are not doing anything. Okay, cool. You can see price has stepped into our near supply zone. Remember when I told you that inducements tend to form at a point of interest? This is exactly what I mean. At this point of time, just because price has stepped into a supply zone does not mean that price is going to go down straight, okay? What can happen is that it can create inducements, traps, to entice retail traders to enter a sell position early just for price to go up there, sweep the available liquidity before hitting back down even further, right? So you don't want to enter too early. You want to enter at the perfect timing. So at this point of time, we are waiting for our inducements. Okay, you can see price is reacting at the supply zone, but we are patient. We are not doing anything whatsoever. Because first of all, there is no inducement. Second of all, we haven't got a shift in structure that tell us that the structure have shifted bearish, and right now we're going to continue to go down. Because right now price can continue to go up even further. Okay, so you can see price started shifting bearish, and then we are getting a reaction from this zone right here. And what do we have right now? We have a double top, right? So if you look at this, we got a price reacting from the supply zone, pull back, and then goes up there, react from this supply zone again, and then start coming down right here, right? So there is actually a double top, and remember, double top, the two tops does not have to be the same height, okay? So you can have one that is higher than the other. It is still counted as a double top. And in this case, there is also another double top right here. You can see like a fractal double top right here on the 5-minute time frame. Okay, so right here we got our inducements, very nice double top right here. This is where most retail traders, they might want to enter for a sell somewhere right around here. And if they do enter for a sell here, guess what? They're going to be placing their stop loss above these highs right here. And in this case, let's look at what happened next. Okay, price went down, they are in profit, they are happy, they are celebrating, you know, they are considering getting that new car right now because, you know, they have made 10k and boom, they just lost, I don't know, their life savings or something, right? Too bad for you. You don't understand liquidity, right? So if you're watching my video, you shouldn't be operating in this way. You should be operating like a professional, all right? So at this point of time, we know that, okay, we got that inducement, we are patient, right? We are not trying to enter for a sell here too early whatsoever. We are waiting for our liquidity to be swept before actually entering for the trade itself. And what do we have right here? We got a very nice liquidity sweep, right? Where price actually go up there, sweep the available liquidity above this swing high right here, above this double top, and then right now we can expect price to actually create like that reaction, right? But in order for this liquidity sweep to be valid, it needs to create a sharp V-shaped reaction just like this. So I'm waiting for that still, right? I'm not entering yet. You can see very sharp V-shaped reaction, right? Very nice. Now at this point of time, we got our liquidity sweep, but that does not allow me to enter for the trade yet, because what can happen is that price can still go up even further because the internal structure is still bullish. So you map out your internal structure, you will see that, okay, this is that last swing high, okay, this is the 15-minute swing high, and then this is that last swing low that we have right here, okay? So this is actually our 15-minute swing low. So in order for us to confirm a shift in structure, in order for price to turn bearish, price has to break past this last 15-minute swing low, right? And that will tell us that price has officially shifted bearish, right? So at this point of time, we got our liquidity sweep. We are still patient. We are waiting for our market shift right here that confirmed to us, you know, the lower time frame structure is aligned with the higher time frame structure. Then we will start entering for the trade. And there we have it, a very beautiful market shift. Ladies and gents, this is your entry signal, right? So at this point of time, you know, I will be mapping out the point of interest that led to this market shift. Okay, so this is a little supply zone, okay, or order block, whatever you like to call it, that led to this market shift. And this is where I want to actually enter for the trade. If you have watched my videos in the past, you will also know that this is actually a flip zone because we are reacting from this supply right here. I mean, this demand zone right here. And if this demand zone were to do its job, price will continue to go up. But in this case, it created a reaction right here, right? So this is actually our 15-minute flip zone. And this is where I want to actually look for my entry. Price immediately pull back into the area right there, tap me into the trade. And at this point of time, your stop loss, you can place it above this flip zone, or you can even place it above that liquidity sweep, right? Because once price sweep the available liquidity above this swing high, we know that this high right here is somewhat protected, right? So in that case, you can place your stop loss above this high as well. Okay, so it's really up to you. And for illustration purposes, we're just gonna keep this strategy simple and just gonna target about 3R. Okay, just gonna target 3R just like this. Okay, so obviously I would actually place my stop loss above this flip zone. I wouldn't place it so far up, right? Because I know my shit, alright? So yeah, you can see price pull back, boom, immediately go into profit. Look at that large amount of imbalance. Okay, within like a few hours, it just dropped into our take profit. As simple as that. This is the power of liquidity. When you can understand liquidity, you're essentially God, right? You're essentially God, Now, this is how I personally trade liquidity sweeps. Right, there are some traders out there who might actually enter for a sell somewhere right around here after price sweep liquidity, and in that case, they'll be placing their stop loss above, once again, this protected swing high that swept liquidity, and they could potentially be targeting this area right here. Right, and in that case, that might work for you as well, right? So if you want to do that, by all means go ahead. My advice would always be the same, and that is to test out which entry work better for you. For me personally, I need to wait for the market shift to give me further confirmation, right? And I get that multi-time frame alignment before I can actually, let the trade do its thing. But for some of you guys who might be more aggressive, then in that case, you might want to enter straight away after the liquidity sweep. Find out what works for you based on data that you collect after countless of backtesting and forward testing, okay? Okay, now let's look at the next example that we have on EURUSD on a 4-hour time frame, right? So same thing, first things first, go and map out your structure. You will see that this is the last bullish break of structure that tells us that this is actually the last swing low, and then right here, this is the last swing high. So right now, we know that the objective of price is that it's turning bearish to facilitate that pullback to that last swing low before price could potentially create that new higher low and continue creating your higher highs and higher lows to the upside. Okay, so now that you have understood the objective of what price is trying to do, you must mark up your point of interest, which is step 2, right? And you will see that this is actually demand zone right there, a 4-hour demand zone. And then there is also another demand zone right here. It's a tiny one because what happens is that price actually got there. It pulled back on the lower time frame, make a small little pullback, and then it just goes back up, right? But it is still counted as a point of interest, right? So this is actually our demand zone. Okay, so you can see right now price has actually tapped into this near demand zone, right? So when you look at this, there is 2 demand zones. There's the near demand zone and then there's the extreme demand zone. I personally don't like to enter on the near demand zone because when you enter the near demand zone, right, you try to enter for a buy right here and you place a stop loss below this zone, what happens is that price could potentially come down and tap into the extreme zone before the real move actually happened. And in that case, if you entered once right here and then right now you enter again after price actually come into this extreme zone, you are prone to being wrong twice, okay? Because what happens is that if this zone fails as well, in that case, you have been wrong 2 times. One time right here and another time right here. But if you just enter the trade at the extreme zone, you might just be wrong once and that's it, right? But obviously this depends on different scenarios in the market, but that's a conversation for another day. But for now, price has stepped into our near demand zone, so we are looking at what price is doing at this near demand zone. So at this point of time, price has actually reacted from this near demand zone that we have right here, right? So let's go down to the 1-hour time frame and see what price is doing, right? And you can see we got that price reacting right here, and we know that we are trying to spot inducements at this point of interest, right? So let's continue to play price and see what price does. Okay, so you can see right here, when price actually reacted from this demand zone, guess what? All the retail traders, or rather most of them, they're going to enter for a buy right here, and they're going to be placing their stop loss below these lows. Now, because what happens is that price is just mitigate from their demand zone or their support level, right? So obviously, price is going to go up now. And then later on, price comes down, sweep the available liquidity up below this low right here, and look at what we have. We got that sharp V-shaped reaction to the upside right there. Okay, so at this point of time, we got a strong low being formed, right? Because prices actually went up there and broke structure. Okay, it broke structure right here. Okay, when a strong low is formed just like this, once again, the retail traders, they're going to be entering for a buy right here, and they will be placing their stop loss below this strong low right here. After all, what could go wrong, right? This is a strong low. Price is not going to go lower than this, right? Price is just going to go up right now. So let's look at what happened next. Dun, dun, dun. Guys, come on, guys. You're better than this. This is what happens when you don't understand liquidity. You are the victim of market manipulation again and again and again, right? So wake up, buddy. So what we have right here was that price is just sweeping the available liquidity above this last high right here, just for price to go down even further. And that is why I don't actually recommend you guys to actually enter on the near zone. Okay, so we got that inducement, that strong low inducement right here. We know that there is available liquidity below these strong lows right here. Okay, so I'll just put that that liquidity mark right there that shows us that there is available liquidity below these strong lows. As you see right here, price has just went down there and the available liquidity below the strong low. And right now we can expect price to actually go up right there and then actually creates that real market shift to the upside. Okay, so at this point of time, if you look at the extreme zone is still unmitigated, right? So there is still a chance that price will come down in the future to mitigate this extreme zone before it actually goes up there and break past that last swing high. Okay, so right now, if you did actually enter for a buy right here, after you got that liquidity sweep below the strong low, you can potentially target like this area right here or 1 to 3R, right, like what I've mentioned earlier. But let's continue to see what price does. Because what happens is that if you look at it closely, at a high level, you will actually see that there is available liquidity below this strong low as well, right? So this one is kind of harder to spot, but once again, I just want you to time travel back with me a little bit. Okay, so what we have right here was that this was that last break of structure, right, to the downside, which means this is that last low, and then we got price actually breaking past that last low that we have right here. When price break past this last low, we got a market shift right here, and this tells us that this is the new strong low. Okay, this is the strong low that led to this market shift right here, and because it is just a beautiful swing low just like this, there is available liquidity below this swing low. Okay, so yeah, this one is a little bit trickier, okay, but right now remember your extreme zone is unmitigated. So what can potentially happen is that price is going to come down there, sweep the available liquidity from this strong low before the real move actually happens and take out this swing high right here. Okay, so you can see price came down later on, available liquidity from that strong low. Okay, once again, you must understand the rationale of this. When retail traders, what they will do is that they're going to be entering for a buy right here. Okay, not even retail traders, maybe even a lot of expert traders, they see price actually creating this market shift right here. They'll potentially enter a buy right here after this strong low is created, and that is where they could potentially be target like maybe right here, or maybe even at this swing high, because they're expecting price to take out this swing high, right? And maybe they're placing a stop loss below this strong low right here. Maybe the entry was like right here, because this is a little bit ridiculous, this is a little bit too late. But let's say they have like some good entry. Let's give them some credit, okay? And in this case, stop loss below this strong low, liquidity right here. They are trying to target this swing high, and then they see price going so near that swing high, then bam, reverse against them and hit their stop loss. Now this is where they are raging, alright? This is where they are angry because they just got stopped out right here. And that is really just price sweeping the available liquidity from this strong low, and then the real move actually happens right there and finally take out that last swing high and move up to the upside. Most trading gurus and idiots try to make these liquidity concepts seem like something so hard to understand and complex. But I promise you that by the end of this lesson, you will be able to fully understand what is liquidity and how to spot liquidity correctly. So what exactly is liquidity? You must understand that for every buyer, there is a seller, because there needs to be a seller on the other side to fulfill your buy order. This also means that for every winner, there will be a loser. That's just how trading is like, and every time you lose a trade, you are essentially adding liquidity into the market. This is the key about what we're going to cover later. So this is what it kind of looks like, right? You are a retail trader, you get your trade stopped out because the smart money is so smart enough to know that you are an absolute idiot and purposely gonna push the price down, trigger a stop loss. You lose your hard money, or they just make a shit out of money. Now, liquidity is not a problem for retail traders like us, because we are not trading with a large sum of money. However, it is a problem for the big financial institutions, because they are trading with millions and millions of dollars, which means if they want to enter for a buy, right, they want to buy Euro USD with $1 million, they need to look for someone who is willing to sell $1 million worth of Euro USD to them, which is extremely rare. Therefore, they need a large amount of liquidity in the market in order to place large orders. And how do you think they're going to get this liquidity? By causing you to lose. Because when you lose, you add liquidity into the market. Remember? So let's see what this actually looks like on the charts. So when you see this, you probably think that price is in an uptrend, right? Because price is creating a higher highs and higher lows and higher highs and higher lows. And right now, price is creating a higher highs. So let's say you enter for a buy somewhere right around here. And the first thing you do is to place your stop loss right below this last swing low right here. Now, let's say on the other hand of this market, on the other side of this market, smart money want to buy USD in bulk, okay? And they need a lot of sellers in order to fulfill that order, right? So right below this swing low, we have stop losses from the current buyers who are inside the buy position, the long position. In addition to that, we also have the breakout, or rather the reversal traders, the people who have a sell order somewhere right around here, so that if price actually break through the previous low, they will be entered into a sell position. So here there is sell stops and there is also stop losses of current buyers. So this is what smart money will do. They will purposely manipulate price to grab liquidity by triggering the stop losses of the current buyers and the sell stops of the sellers. And this is exactly why it is imperative that you train your eyes to spot liquidity, because if you don't, you are most likely going to become a victim and lose your hard-earned money if you're on the wrong side of the market. In this case, what smart money did was that they purposely manipulate the buyers to actually enter for buy orders right here and place their stop loss below this low, and also all the sellers who have their sell stop at this area right here, and then they purposely push the price down, triggering all the orders that we have right here. And all these buyers and sellers, they're out of the market right now. And when they lose a trade, remember, they add liquidity into the market. And that caused price to just hit up in like a rocket way, it literally skyrocket, alright? And when this happens, this is actually what we call a liquidity sweep, right? Where price has already created that liquidity sweep, come down here, grab all the liquidity before fueling the up move right here and continue heading back up. Now, quite simply put, liquidity is basically pending buy or sell orders plus stop losses. Now, the question becomes, how do you exactly spot liquidity when you are trading? And that is where the concept of liquidity zones come in. So liquidity zones are basically where resting pools of orders are sitting and where institutional activity may have occurred. Like I said, our job as traders is to follow the footprints of the institution traders, the big financial institutions, the smart money, because we understand that they are in charge of this huge move. And in order for us to, get in with those huge moves with them and trade with them rather than against them, we have to understand these liquidity zones and make sure that we identify them properly. So there are a few types of places where there will be a lot of liquidity, right? And those are your equal highs and lows, your swing highs and lows, your trend lines, and your support and resistance levels. If you look at these liquidity zones, right, you'll realize that these are actually things that retail traders look at. Things like your trend lines, your support and resistance levels, even your double top and double bottom right here, right? Retail traders are looking at this and they are placing their buy or sell orders based on these patterns that are showing on the charts. And that is exactly why these are pending orders yet to be filled, which give us liquidity. So let's go through one by one. So if you look at equal highs and equal lows, this is actually your double top and double bottom chart pattern, right? Is where price creates the first top and then come back up to retest that top before collapsing. And when retail traders, they see this, they will most likely enter for a sell right here, right? After price creates this double top. And what happens next is that they're going to be placing their stop loss above these stops right here. And this gives us liquidity, right? And there will also be breakout traders who will place their buy orders right here, right? Pending buy orders right here. So that if price eventually break above these highs right here, they will be triggered to enter for a buy order. So you can see, buy orders right here, there is also stop losses right here for the sellers right here. And both of that give us liquidity at this area right here, your liquidity zone. And sometimes what smart money will do is that if there's not enough liquidity for this move to happen, right, price will be pushed up right here, triggering out all the orders, all the buy orders, all the stop losses right here before pushing back down here and go back in that particular direction. Because right here, it created your liquidity sweep, right? It gives the price enough fuel to continue this down move. So this would have been somewhat of like a liquidity zone right here that have been tapped into. Same thing with the double bottom, right? Just the opposite of a double top, right? There is liquidity below these lows right here, and smart money, they might push the price down here, break past the previous swing lows, grab liquidity before heading back up. Now next is your swing highs and your swing lows, right? We know that in an uptrend, price is creating your higher highs and higher lows, and in a downtrend, price is creating your lower highs and lower lows. And within this swing highs and swing lows, there will be your stop losses, your pending buy or sell orders once again. There will be liquidity. Now in this scenario right here, price actually created an up move right here before it starts retracing and then creating another push phase and create your new higher high right here, right? And then what happens next was that price actually goes down and actually break past the last higher low, right? And when this happens, this could signify to us that price is about to change, right? This uptrend that we had previously could potentially be changing into a downtrend. In this scenario right here, what price will most likely do is that price is going to come up here to somewhere right around here and create a lower high before continue back down, right? Because chances are if price break through the last higher low to somewhere right around here, it won't have enough liquidity to continue this down move and go all the way straight down, right? Remember, price will always have to retrace, and that is why it needs to retrace so that they can have more liquidity before pushing price down even further. And that is why price will retrace to this zone right here and grab the liquidity around this area, create a lower high before continuing down even further. Same thing in this bearish scenario right here, right? Price will most likely come down here, retest, create a new higher low right here before continuing the uptrend. Now, if you're still unclear of what liquidity is basically a magnet for price to be attracted to, because the market needs to rebalance and in order to fuel further move, right? Because the price cannot go up forever or go down forever. It's to go down, retrace a little bit so that they can gain more fuel, just like a car, before continuing and heading back down, right? The market will never ever move up or down in a straight line. It needs some sort of fuel, and that is where liquidity come in. And then you have your trend lines, right? Trend lines is where, if price is creating an uptrend, right, you can draw your trend line connecting all these higher lows right here, which means all the stop losses are going to be below all these higher lows as well, and which means there's going to be liquidity below this area right here. So that is exactly why sometimes smart money, what they will do is that they will push the price down and actually break past the trend line and actually still head back up, right? Because they know for a fact that if they push the price, break past the trend line that we have right here, you retail traders are going to think that this trend line is no longer working and you will get out of your position, or you might even enter for a sell because you see this as a trend line break. And in that scenario, you have been 100% wrong, because smart money will just push the price up like this. Once again, this happens sometimes, not all the time, but sometimes. Sometimes a trend line break will be valid, sometimes it won't. And lastly, we have our support and resistance levels. The most simple concept that you guys learn when you start trading, and is actually the biggest threat, right? Because like I said, smart money knows that you are trading based on this support and resistance levels, and they're gonna take advantage of you, right? They're gonna take advantage of your stupid brain. So what they're gonna do is that they know that you can have a resistance right here. They'll push the price up, break past the resistance, triggering your stop loss for the sellers, and also making the buyers think that price is gonna break out right now. And then they're gonna push the price back down, and then they're gonna break past the support, and then they're gonna push the price back up and down, and they're just gonna play mind games with you, right? And in reality, what they are really doing is that they are really trying to trigger your stop losses, cause you to get out of your trade, so you add more liquidity into the market and fuel their move. And a lot of times you will see this pattern happen over and over again, where you maybe enter for a buy right here and you place your stop loss like below this low. Price will purposely get all the way down here, push all the way down here, hunt your stop loss, trigger a stop loss before heading back up in that particular direction. And then you're sitting there regretting, like, oh my god, I should have placed my stop loss wider because price purposely hit my stop loss and then go up. Oh no, I'm bitch. Oh no, my trade did not go as planned. Now in that case, you deserve it because you don't understand how liquidity works. If you understand how liquidity works, you will know exactly what price is going to do next. And that is when this quote comes in. If you can't identify the liquidity, then you are most likely the liquidity. Now let's go on to the charts and actually apply whatever we have learned so far about liquidity and see how all this works on the charts. So when you look at any chart, right, the first step you should do is to identify the market structure. I've mentioned this for like the past 3 years, right? The first thing, identify the market structure. Because you cannot spot liquidity if you don't even know what's the overall trend direction, you don't even know what's the overall order flow of the market, whether it is bullish or bearish. So first things first, identify the market structure. And you can see price is creating your lower highs, lower lows, lower highs, and lower lows. And you can see price created a lower high right here, and then it break past this previous low, creating your bearish break of structure right here, before retracing, creating another lower high, and then creating another bearish break of structure right here, right where price broke past the last lower low. And right now, price has retraced once again, creating your new lower high, but it has not break past the lower low right here yet, right? You can see this is the last low, and right now, most likely, if price is going to respect this lower high, price is going to go down here and break past this lower low right here. So ideally, that is what we want to see in price. But if you observe closely, what do we have right here? We actually have your equal lows, right? Your double bottom. This means that there will be liquidity in this area right here below all these equal lows. So you can actually mark up like a little liquidity zone right here. I just like to put dollar sign because yeah, it shows me that smart money are actually going to enter into the market soon. So we can expect price to actually goes down here, sweep the liquidity below this low before heading back up, right? That is what we could potentially expect. But like I said, we never ever want to make sure that we assume what price is going to do. We always want to make sure that we actually react to what price is going to do, because price can actually goes to somewhere right around here and then even go back up like this, right? So we always want to make sure that we look and be patient to see what price is going to do next first, then enter for our trade. So you can see price goes down slowly, and you can see price breaks past the equal lows that we have right here. So the retail traders who are bullish because they see this double bottom right here, they're going to be entering for their buy position right here and place their stop loss below these equal lows right here, because they see this double bottom pattern, and you know, textbooks are showing them that double bottom means you should enter for a buy, right? And they place their stop loss below these equal lows, and look at what happened here. Price got pushed down, triggering all their stop loss. So the buyers who actually enter for buy position right here, they're out of the trade. Okay, so they add liquidity into the market already. Now on the other hand, we also have retail traders who are breakout traders. That means that if they see price break structure like this, right, price break past the last lower lows, means what? Price is going to continue going down already. They're going to be entering for the sell position right here as well. And when they enter for the sell position, upon the breakout, they're going to be placing their stop loss above right here, right? Above right here. Above this liquidity zone right here. And in that scenario, look at what happened next. They also get stopped out. When both sides, the buyers and the sellers, the retail traders, they are completely out of the market, smart money was able to grab liquidity right now. So in this scenario, instead of entering for a buy here or a sell here, you should have been very patient to wait for price to actually break past the equal lows right here and create what we call your liquidity sweep, which I showed you guys just now, before entering for the trade. So in this example, we actually had a liquidity sweep right here. Because trust me when I say that if price wanted to go down, right, price will create this massive momentum and just goes down, create a lower high, a lower low, lower high, and lower low. But that is not what it actually shows us. If you observe the candlesticks that's forming right here after price has broke past the equal lows, price is giving us small candlestick right here. And then look at these two candlesticks right here. This shows us that the selling pressure, the selling momentum is gone. The smart money or rather is potentially going to enter into the market soon. And they're going to enter for buy position in bulk, right? And you can start seeing some sort of bullish momentum right here. So this is where you can actually enter for a buy position right here, place your stop loss below these lows right here, a better entry be right here, right? That immediately when price starts showing some sort of signs of bullishness after price actually grab liquidity, right? That is when you can enter for the trade, stop loss below these lows, and you can take profit at these highs that we have right here. And once again, if you look at this, what do we have right here? Your double top. So there is going to be, once again, the same thing, liquidity waiting for you at this area right here. So that will be a very good take profit for us, right? And that is, we can place our take profit right here. 1:5 risk to reward ratio, and look at what price does. Price goes up, smash our take profit. While all the retail traders in the world just lose their hard-earned money, we are over here making their money, stealing their hard-earned money. And that's just the cold hard truth of trading, right? Trading is a zero-sum game, right? It's either you become the winner or you become a loser. And after watching this video, if you can implement the advice I give you in this video, you will be the winner that actually takes the money away from the loser. Because if you can understand liquidity properly, right, you will no longer be a victim of the market. You will actually be part of the smart money and be able to, not get your stop loss liquidated all the time and not lose your hard-earned money all the time, but instead be making profits just like this. And right now, since we're out of this trade, right, potentially we have identified your equal highs right here. We're going to be waiting for price to sweep the liquidity above these highs right here, and then that is when we can enter for a sell position, right? Because if you look at the overall trend, we are still in a downtrend, right? Once again, we are still in a downtrend, and ideally, we want to trade with the trend, right? And in that scenario, we want to be looking for our sell position at these lower highs that's forming right here. So chances are right now, price is potentially forming a new lower high before heading back down to create your new lower low. So right now, we are waiting for price to take out these equal highs to create a new lower high right here. And then that is when we can look for our short position and take it all the way down to the next lower low. So that is what we're going to be waiting for, right? We are waiting for signs that show us that this little retracement is going to be done. And that is only going to happen after price has officially swept the liquidity above its highs right here. You see, price goes up there. Once again, sweep the liquidity above these highs already. And that is where you can potentially enter for sell position somewhere right around here. Once again, what happened right here? Do you guys realize that I didn't enter for sell position right here? Okay, let me just bar replay right here. You see, right here, price created a double bottom, and I could have entered for sell position right here immediately after price created this double bottom. But I did not do that because I know that if I do that, I'm going to place my stop loss right here. And once again, what is that? That is your liquidity above these highs right here. So what I want to do is to wait for price once again to actually take out the liquidity above these highs here before entering for my sell position. You can see, bam, right there. That is when potentially a liquidity sweep is going to happen soon. Look, boom. There we have it. The liquidity sweep just happened right here on this double top, and this is potentially a new lower high on the overall trend, right? You can see overall trend, this is the last lower high, and this is the next new lower high, and then this is the most recent lower high. And if you look towards the left, there is actually your supply zone right here, right? There is your supply zone right here. And just nice, price has mitigated your supply zone. Price mitigated your supply zone, you got your liquidity sweep right here, and based on market structure, price also in a lower high. And yeah, based on that, we got all the confluences in the world for us to actually enter for a sell position somewhere right around here. Place your stop loss above this highs right here. Ideally, I will potentially enter for the sell position on like a 1 hour time frame, like a smaller time frame, and I will enter like somewhere right around here. And then I will move my take profit all the way down here at this area right here, right? At this is the last low, and you can also draw like a little demand zone here if you want. And yeah, this would have been like a very nice potential trade right here. You can just see on a higher time frames, price goes down, and eventually smash our take profit, right? Somewhere right around here, smash our take profit before price actually reverse and hit back up here. Now, in this scenario right here, right, the moment price actually comes down here, tap into this demand zone that we have right here, you can manually just take profit and get out, right? Ideally, like I said, I will have take profit somewhere right around here. I'll just refine this zone a little bit, somewhere right around here. And yeah, and that will be my take profit. Price tap into this zone and then reverse and hit back up. And look at what price does once again. Price grab the liquidity below these lows that we have right here, right? Chances are, if you look at it, from here, there is actually a support level right here, and price actually creating your liquidity sweep right here before getting the momentum and hit back up. Now, let me show you guys another example to make things much more clearer to you, and this time around in an uptrend. So let's say price in an uptrend once again, creating a higher highs, higher lows, higher highs, and higher lows right here. And like I said, nothing goes up forever. It needs some sort of momentum. So let's say price is in an uptrend right now, lots of bullish momentum right here, and we could be expecting price to create a new higher high right here. Price created a higher low right here, so I can actually mark up this low right here. And then price is actually also created a higher high right here. We know that there is going to be liquidity above these swing highs right here, right? Above these swing highs, there's going to be liquidity, and then there is also liquidity below these swing lows right here. So we are waiting for price to sweep the liquidity either from the upside or the downside. So we still wait and see what happens next. Right here, price goes up here, sweep all the liquidity that we have above these swing highs right here. Now, what do you think is going to happen next? We still wait. First of all, you could have easily entered for a sell position right here, right? Right after price sweep the liquidity right here, you can enter for a sell position right here. And then place your stop loss above, place your take profit all the way down at this swing low. So in this case, right, after price has swept liquidity from the upside, look at what happens next. Price goes down here and go all the way down to this low that we have right here. So if you actually enter for a sell position right here, right after this liquidity sweep, place your stop loss above these highs, you will have made like a very nice 1:6 risk to reward ratio trade. Very, very nice. Now, observe where price goes next after price reverse at these higher lows. It goes up here to the liquidity zone that we had earlier, right? Remember, there is liquidity above these highs right here, and then there is also your liquidity zone right here. So this whole entire zone is your liquidity zone. So if price goes up here, we know for a fact that smart money is potentially going to enter for sell orders right here. Right, because once again, there is selling liquidity at this area right here. So the moment price reach up here, you could potentially enter for a sell somewhere right around here. After getting some sort of selling pressure, right? Some sort of signs that actually show you that there's selling pressure, and therefore sell right there, place your stop loss below these lows once again. I will ideally place my stop loss above these highs right here once again. Right, you can see price obviously sweep the liquidity above these highs that we have right here before heading back down. Sweep the liquidity right here before heading back down. So when price is breaking past this liquidity zone that we have right here, right, I wouldn't be really worried, right, if you could even like go down to like the smaller time frame and you realize that price is just simply sweeping the liquidity above these highs right here. So if you want to have like a much better entry, you could have probably entered somewhere right around here. Right after this liquidity sweep happen, you see this first sign of selling pressure right here, right? Your bearish candlestick, place your sell order right there manually, and then you can actually place your stop loss above these highs and take profit at this area right here. And you can see, huge move, right? Huge move happens right after price actually sweep the liquidity above the highs right here. Now, the thing about liquidity is that I don't really use liquidity as my main confluence. I use it as an additional confluence for me to confirm for my entry. So what that means is that I'm going to be focused on market structure, supply and demand, first as the foundation before even thinking about liquidity. So I want to enter for a trade based on market structure, right? I want to enter for a buy based on an uptrend, and I'm going to be seeing whether the internal structure align with the external structure or not. And then I'm also going to be waiting for price to get to your supply or demand zone. And then finally, then I'll look at liquidity. So my focus is never on liquidity, because liquidity is just an additional confluence for you to enter for the trade. What this means is that you need to master market structure and supply and demand zones and even order blocks first before you can even think about understanding liquidity. So inside this full, complete course on order flow, here's what you will learn. What is order flow? Why use order flow? Right, we help you gain a deeper understanding behind the dynamics of order flow and how price move, right, imbalance versus balance, and how order flow actually move prices, and how to trade with order flow using both footprint charts and candlestick charts. Now, please watch this video in order from start till the end. Don't skip around, right? If not, you won't be able to understand what I'm actually saying, because you need to have a deep understanding of how price works on the fundamental level in order to understand and master order flow. And like I said, if you don't have the attention span to even watch finish a goddamn video, how are you gonna have the patience to become a successful trader? Dumbass. Now, what is order flow? Order flow trading allows you to see the interactions between the buyers and the sellers in order to identify who is in control of price. And that's really all successful trading is about, right? It's about figuring out who is in control of price, whether the bulls or the bears, and being on the correct side of the market. It's the process of analyzing the flow of trades being placed by other traders, institutional traders, retail traders on a specific market or an asset by watching the order book or footprint charts, right? So this really allows traders to see the amount of buy and sell orders that are being placed at a certain time in the market at a given price point. And guess what this allows you to do? This allows you to anticipate changes in price before they even happen. So the truth is, why do we use order flow, right? What is so magical about order flow? And the truth is, order flow is not a holy grail, right? But it allows you to figure out what price is doing, and that's the most important thing ever. And it is not lagging. That means it's not moving like a snail, like all the other trading indicators. So if you are still trading with goddamn moving averages, Bollinger Bands, RSI, understand that you are a bit late to the party, buddy. So in trading, the fastest finger wins. If you are able to understand order flow, you will be able to understand how the market moves, and most importantly, how price works. And this really allows you to gain such a deep understanding of the market and change your paradigm so that you are aligned with the professional traders that actually know how to move the markets, right? And this really allows you to overtake all the other retail traders, like what Usain Bolt is doing right here, who are still relying on all the lagging trading indicators of freaking stupid chart patterns right here, right? All these guys here, right? So don't be like these guys here. Be Usain Bolt, my friend. So by trading order flow, you are able to gain an edge over the retail traders, right? Pretty much the entire retail space. Because trust me, no retail traders are going to be looking at order flow. Who the hell cares about order flow, order book, when you can rely on chart patterns, you know? Because when you are trading order flow, you are able to see institutional activity. That means you are able to see what all the big boys, the smart money, the financial institutions, the investment funds, basically all the smart money, what they are doing. And if you're able to see what they are doing earlier than the rest of the world, you will be able to trade with them. So when those big move happens in the market, you will be able to get in before they actually even happen. Now, not only does it allow us to spot institutional activity earlier, it is also much more reliable since it comes straight from a centralized order book, right? An order book is basically where you see all the limit and market orders that is existing inside the market, right? So all the buy or sell orders is all shown on the order book. And this centralized order book literally shows everything, all the orders. This means there is no hidden orders from the black market or something out there, right? It's all on the order book, right? Like, come on, all the orders are literally displayed right in front of your face on the order book itself, and that relationship really helps you understand what's actually going on in the current market environment. And when you are really able to understand what's going on, you are able to be in sync with what the market is actually doing, right? And you will be able to really ride the liquidity. And quite simply put, market liquidity doesn't lie. Numbers can't lie, right? You are literally looking at cold hard numbers which tell you exactly who is in control of price, and yeah, there's no way that it's a lie. It's cold hard truth. So the financial markets work based on the auction market theory, which states that financial markets are just like any other business in this world, meaning there's going to be buyers and sellers, and they are both actively trying to seek the fair value of an asset, right? This theory is based on the principles of supply and demand and the auction process. And that's really how the world works, right? If you go to the market, right, you're essentially buying from a seller. And if you are trying to sell away your used car or your Apple, iPhone or whatever, you are essentially looking for a buyer to fill up your sell order, right? Same thing with the financial markets. So let me just give you a quick example to really deepen your understanding behind this auction market theory and what is this complicated, weird-ass term all about. Say, there is a beautiful 5-bedroom house that is on auction right now, and is priced at $400,000. Now, since this house is so gorgeous and is located right beside the beach, you know, it has such a great location, people perceive this house as valuable. So they start bidding for it. I want to buy this house at $420,000. I want to buy this at $430,000. And then when this happens, this creates demand. Right, this creates demand for the house, and since there's only one house and there's so many people just bidding for the house, demand exceeds supply, right? When demand exceeds supply, this drives the price of the house up to $450,000. Now, this is the new price that the market deems is fair. Meaning, this is the fair value of the house. Now, suddenly, let's say there's a bad news. Okay, bad news come out about the house is being announced. The roof is falling apart. It does not include furnitures, right? So whatever you see right there, it's just your imagination. It's not real, right? You are not gonna get the nice leather sofa. It's not included with the house. Boom! When this happens, people start backing out. Yeah, come on, man. This is what I expected, and this is what I get. Come on, doesn't make no sense. So people start backing out, and since less people want the house now, supply exceeds demand, right? And this causes prices of the house to drop to $420,000, which is the new fair value of the house, right? Is the price where the bidders, they deem as fair. Since now it has taken into account all this bad news, right? And if they project the cash flow, right, how much return on investment this house can actually get me, is actually not that great, right? So this is the new fair value. However, let's say later on, good news come out again. If you buy this house, you get a nice Tesla, right, for free. Buy one, get one free. This is obviously not real, but like, let's say it's real. Later on, good news come out, and this causes price to actually increase back to $450,000, right? Because now there is people who is more interested in the house, and demand exceeds supply once again. Essentially, this is what happens in the markets every single day. Every single day, buyers and sellers, they meet each other, and what they are doing is that they are trying to find the fair value of an asset, be it a stock or a crypto coin or a forex currency pair, right? Which result in buy or sell orders, which pretty much constitute the order book and mix up the order flow. And this is exactly why price is always moving from balance to imbalance to balance and imbalance, right? If you look at the charts right now, any price charts on TradingView, whatever, you will notice this common similarity. And this is essentially just how the markets move on a fundamental level, right? To really understand how it moves on a fundamental level, you need to understand the concept of balance and imbalance. So in a balanced market, buyers and sellers, they agree on a certain price based on their perception of what is fair, your fair value. And this leads to lower volatility, and price just remain quite stable, right? And this causes price to range, right? Just stuck in a consolidation just like this, where it's just going sideways and not really going anywhere. However, financial markets, they can't stay in this balance forever, because new information is going to come in. New information, whether that is fundamental news or it could be technicals, right, based on price action. This causes markets to move away from the fair value and transition into a completely different environment, which is your imbalance, right? An imbalance occurs when there is a disagreement about the fair value. And this is where one side of the market participants, be it the buyers or the sellers, they actually become more aggressive. And this leads to a trending market. And imbalance actually causes price to either move higher or lower until eventually this imbalance fades away, doesn't have enough momentum anymore, and it stops and price starts consolidating again, going back to the balance phase. And then eventually it can't stay in the balance forever, so it eventually break out of the balance phase, go into the imbalance phase, back to balance, and this just happens over and over again, right? And this is essentially just how the markets work. If you think about it, this is actually how the universe and how life works. It's always a balance between chaos and order, yin and yang. So, quite simply put, the market are basically an oscillation between imbalance and balance, because it is always seeking fair value. When there is an efficient market, it is not able to stay in there forever, because eventually, due to some sort of new information, demand will exceed supply or supply will exceed demand. And then when this happens, this causes your imbalance to occur, right? Where there's a lot of buyers, very little sellers, or a lot of sellers, very little buyers. Imbalance, right? Just imagine a seesaw, right? It's like not balanced right now. That's why we call it imbalance. And when there's this imbalance, creates inefficiency in price. And then price look for balance again to form an efficient market. And this whole loop just keep happening over and over again forever. And this is essentially just how the market works. Don't ask me why. This is just how it works, right? So your goal as a trader is to really make sure that you can capitalize on the imbalance move, because that is where the big money is at. Just think about it. When you go onto the charts, you identify all those large moves that you always miss because you suck at trading. These are where the big gold mine is. This is where you're able to make the most amount of money by really capitalizing on all these large moves. So like I said, your job is to look for this large move and actually get in before they happen, so they can ride this large move and make a lot of money very, very fast. Now, when you look at a candlestick chart just like this, it doesn't really give us information that tell us about volume, price, and the exchange between sellers and buyers, right? When you see something like this, all this green candlestick tell you just that this is actually a bullish candlestick, right? And this tell us that, okay, there's buying momentum and price is going up. But that's all it is. That's all a candlestick chart tell us. And then if you see a red candlestick, it just means that price is bearish and price is going down. Now, you're essentially looking at the outcome of buyers and sellers, right? You are not looking at how it was being formed. And looking at just at what price is doing, like what's the outcome, right? It doesn't really tell you what is going on at a deeper level beneath the candlestick. And that is when your footprint chart come in, right? So this footprint chart, how it works is that, once again, it dissects the candlestick into orders, right? So the right hand side, all these numbers right here, it basically show you the buy orders, right? The market orders on the right side are the buyers, right? So you can see all these numbers is essentially how much buy orders at the specific price. And then on the left hand side, this is basically how much sell orders on the left hand side. What a candlestick does is that it just show you the outcome, right? It shows you the high price, the close, the open, and the low. But a footprint chart actually show you how many orders, how many buy or sell orders happen at each price, each pip. Now, this is important because when you are able to get so much more information when it comes to volume and the exchange between the buyers and the sellers, between the supply and demand, this allows you to really understand on the fundamental level who is actually in control of the market. And yeah, this is just very powerful. If you can really look at this footprint chart and actually understand what is going on with all these random ass numbers, you will be able to understand that nothing is random in the market. Now let's talk about how order flow actually move prices, right? And let's kind of understand how this footprint chart works on a deeper level. So when you look at your bid and ask spread, or rather this is actually your order book, right? So let's look at the order book, and how this order book works is that these numbers on the right hand side, these R's, right? These are essentially your sell orders. Okay, as simple as that. These are your sell orders. And then this bid right here, these are essentially your buy orders. Okay, but here's the tricky part, right? These numbers right here, right, it represents the amount of orders at the specific price. So this is essentially 1,103 sell orders at this price, and then this is 1,687 sell orders at this price. But you can see this is the market price. This is where the market currently is at right now. This is price of a specific asset right now. So over here, right, all of this right here, all of these are essentially what we call your limit orders. Now, if you don't understand what are limit orders, they are basically orders that have yet been activated. They are pretty much pending orders inside the market, right? Because right now, this is where the market is at, right? This price right here is the price of the asset. And right now, these sellers, they want to actually enter for a sell at this price. They want to enter for a sell at this price or this price, right? And you can see these are the different number of orders that is located at different prices, right? These are all limit orders which haven't been activated yet. Now, let's say there is an apple that costs $5, and this is just to help you understand what is the difference between limit order and market order. So apple costs $5. A market order is you buy the apple right now at $5, right? You don't care about what the price is right now, you just buy. Okay, that's a market order. You execute at the current market price. A limit order is when there's some sort of condition. you only want to buy an apple only if it costs less than $3. Okay, that means that $3, it's actually below the current market price, which is $5. So in that scenario, I only want to buy when it's at $3. But right now, it's not at $3 yet. So I will wait until price of the apple drop to $3, then I will get in for the order, right? So that is essentially what a limit order is. Now, the apple will be bought when its price dropped to $3 or lower. So quite simply, when you look at order flow, if you think about it from the first person perspective, right, or the underlying belief, order flow is essentially an interaction between your limit orders and your market orders, and this pretty much forms the liquidity that you see in the market. So let's say John, right? John, this guy is a trader working for a large financial institution, and this guy has insider information, right, which is not accessible to public, right? That is why, right, when you look at news and you expect the news to actually come up and actually cause price to move, but then price has already made a huge move before the news even come out. And that's most likely because these institutional traders, this smart money, they have inside information and they act on it before the news actually come out, which result in all this large move before they even happen. So yeah, let's say John, this guy, right, he's an institutional trader, right? So that means he's managing millions of dollars. He has a lot of buying power, right? And he has insider information which happens to be positive news. So he has to act on this information as soon as possible before the market knows about it, before the news come out and the market takes into account of the news. He has to act on it right now. So he's not going to be placing a limit order which will take like a few hours to fill up. He's going to execute the market order which allows him to get into the buy position immediately, and he's going to do it with a large sum of money. And I'm talking about millions, if not billions of dollars here. And this is essentially where a process actually create imbalances, right? This actually fills up all the asks on the order book, right? It fills up all these ask orders. You can see previously it was like 1,000 sell orders right here, right? Thousands of sell orders, but right now it's all being filled up. Boom, 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 boom. It's all been filled up. And when this happens, it's because he was able to execute a large buy order, right? He was able to enter into the market in bulk. And this creates massive imbalances in the market. If you look at the left hand side, right, it creates your imbalances. And like I said, your goal as a trader is to really spot the imbalance move before they actually happen so that you can ride the big money and make bank. Now, how do we spot these imbalances and order flow? By utilizing footprint charts, right? And that's what we're going to talk about next. So where do you actually find footprint charts? There's actually three main software that you can actually find these footprint charts to trade with to really understand the underlying order flow. And first is ATAS, and second is TradingView, and next is Sierra Chart. Right, in my opinion, I think ATAS is the best software to actually use when it comes to finding and actually utilizing your footprint charts. But like I said, here's a quick note: footprint charts are not cheap at all. Yeah, it's actually not cheap. So if you want to trade like professional trader, because this is what professional traders look at, it's not going to be cheap. Just going to warn you. And yeah, different software have different packages and different pricing for the footprint chart. Anyways, now let's go on to the footprint charts and let's learn how to trade order flow. Now, when you go on to TradingView, you have the option to switch to your footprint charts just by pressing this button right here. And right now, you're probably on the candlestick charts. You just need to press it, click, and volume footprint, and then you will be able to switch to the footprint charts. Bear in mind, this is only on the premium plan and above, so you do need to purchase a subscription with TradingView in order to access these footprint charts. Like I said, it's not cheap, but if you want to be serious in trading and you want to add this footprint charts into your arsenal, then this is something that I recommend you to actually invest in. Right, so let's dive deep into how to actually read these footprint charts, right? So I'm just gonna zoom into one candlestick like this. So over here we got the candlestick, and on the right hand side we pretty much got the buying volume, right? The buy orders, and then the left hand side we got the sell orders, the selling volume, right? So this is basically your bid and ask, right? So when you look at this, you can see there's a lot of things going on here, but like I said, I'm just gonna simplify things with you guys by having like a little description for you to actually understand what's actually going on with this footprint thing here, right? So first of all, maybe you want to copy my settings. So let me just show you my settings. You can just pause the video right now and you can just copy these settings that I have right now. And basically, the darker the gradient, right? You can see the darker the gradient of the footprint rectangle thing, the more volume that is, right? The more orders that is, right? So let's go dive deep into understanding how to actually read these footprint charts, right? So once again, left hand side, what you see is your sell orders, and like I said, the darker the color, right, the more order there is, right? So you can see the number in the middle, that pretty much just represent the number of limit orders, right? That pretty much represent the number of orders inside the market, right? Limit or market orders, right? So you can see the gray box basically represents like the most amount of order. So pretty much this pricing right here, 1.084 area, this is when there was the most amount of buy orders and there's the most amount of sell orders being filled up, right? So you can see 4.622k buy orders right there, 3.828k sell orders right there, right? So that's basically how you read these numbers, right? So first thing you have to understand is that the darker the shade of the green or red, right, the more orders there is, and yeah, the higher the number is basically means that is higher amount of orders, right? It's not rocket science. And then when you come down here, this delta thing, right? Delta, this number right here, it basically represents the difference between your buy and selling volume or orders, right? So it's basically you just take the total amount of buy orders, right, minus the total amount of your sell orders. Okay, and then the total right here, this number right here is pretty much the total volume, the total amount of orders when this entire candlestick was being formed right here. Okay, so if you see like a positive delta number like this, like 7.534k, that's pretty positive, right? This tells us that there is aggressive buying. Now, if you see a negative number, like say maybe this one right here, yeah, this one right here, you can see this means there is aggressive selling, right? And one thing to note is that just because the number is positive or negative does not really mean that the number, like, it correlates to who is in control of price. For example, right here, even though the delta was negative, right, meaning there is a lot of aggressive selling going on here, the candlestick actually end up bullish, right? It end up being a bullish candlestick, which means the bulls are actually in control of price, even though there was a lot of selling. So yeah, that's one thing that you guys have to be careful of. Don't just assume that just because the delta is negative, that means that sellers are in control, or just because the delta is positive, buyers are in control. Now, that's basically how this entire footprint chart actually works, like how you actually read it. And there's different type that you can actually choose from. You can see this is the normal buy and sell one, and then you can have one where it's the delta one, which is just focus on just like one row instead of having two rows where it differentiate the buy and sell one. You just have one row, which shows you the total buy volume here, total sell volume here. And then if you go to the total, this is just volume, right? It's just really looking at the total amount of orders, total amount of volume. So yeah, that's pretty much how it is. We're just gonna stick to this one because this one really tells us the buy orders, the sell orders, and whether there's any sort of imbalance whatsoever. Okay, so that's basically how you understand a footprint chart. Now let's talk about how to actually trade it, how to actually add it into our trading arsenal. First things first, this is a very important thing to note, right? I don't really like to jump straight into the footprint charts because this is what your charts will look like. If you just jump straight into the footprint charts, it's very hard for you to understand what's actually going on. So what I like to do is that I will start off by analyzing my charts on the candlestick charts, you know, a normal candlestick chart. And how I trade is that I always like to build the higher time frame narrative first. That means I need to understand who is in control of price on the higher time frame. And to do that, I don't really need to look at footprint charts to actually confuse myself. I just look at candlestick charts, I analyze the price action, I look at the market structure to see whether price is in bullish or bearish order flow, right? So obviously, first things first is you map out your market structure, right? So if I have to map out my market structure based on what we have right here, you can see price is pretty bullish right now. So price actually created a market shift right there. And then this led to the market reversing from bearish to bullish. So now, based on looking at the candlesticks alone, you would see that the buyers are actually in control of price, right? There is more demand than supply in the market. and then when price actually break above the market shift, it actually end up creating a new higher high, higher low, and it's starting to create a new high. So I can actually have my bullish break of structure right now, right? So that's all I'm trying to do, is to really map out the market structure, identify any sort of underlying point of interest. Maybe there's like a supply zone that we have right here, right? You can see your supply zone, mark up any significant point of interest, then there's a demand zone right here. So we are pretty much playing within this range right now, right? So the first things first is to always go and build the higher time frame narrative to see what is the range that you are trading within, and also to see whether price is in a bullish uptrend or a bearish order flow, right? And we do that just by purely looking at candlesticks, right? And really analyzing the market structure. Now, my point, or rather, here's a tip for you guys, because this is what I do, right? I just wait for price to get to a point of interest, then I switch to footprint charts. Okay, so I only switch to footprint charts when price get to some sort of demand zone or supply zone or order block or sweep zone or flip zone, some sort of point of interest. Because what I'm trying to do is to figure out whether price will respect or disregard that point of interest, like just blast right through it. And how I know that price will actually respect this point of interest is when I go down and look at the footprint and I see whether the sellers or the buyers are in control of price at this area, right? If at this area, this buying momentum, it starts losing some sort of momentum, right? And I can see like the buying volume fading away, right? The buy orders are fading away, and the sell limit orders are just filling up, and it's gonna cause price to actually respect this supply zone that we have right here and actually go down. If I am able to see sustained buying pressure, and actually there's a lot of buying volume and it can actually sustain, right? There's actually aggressive buyers and the buyers are still in control, then most likely it's gonna pierce right past this point of interest that we have right here. Okay, so right now price has reached our point of interest. Let me just delete this, and then I will probably just switch to the footprint charts right here, footprint charts, and then I will go down to perhaps the smaller time frame to analyze what price is doing at this supply zone, right? So like I said, right, just because you get a negative delta does not mean that the sellers are in control of price, right? So you just need to understand that what this footprint charts does is that it tells you who is more aggressive and who is more passive. Now, the aggressive people are the ones that is filling up the market orders, right? They're actually filling up the market orders. They don't care about what price the market is at right now. They just want to enter for the trade. Those are the aggressive traders. And then the passive traders are the ones that have their limit orders, right? They have their buy limit orders, they have their sell limit orders, right? They are not as aggressive as the aggressors, right? And yeah, that's basically what footprint does. It shows you who is more aggressive, who is more passive. And like I said, the higher the number, the more aggressive the person is, right? The traders is. And like I said, most importantly, you just want to focus on the volume, right, at the point of interest. So right now, price come into this supply zone. How do we know that price is going to respect this supply zone? We need to see that the price actually loses control, right? I mean, the buyers actually lose control at this supply zone. That is what we want to see. If price were to respect this supply zone and reverse, you must see the buy orders, right? The buying volume fades away and supply step into the market and take control of the market, right? That's all we are trying to do. So right here, you see price approach this supply zone, and if you are observing the delta that we have right here, right, and looking at the total orders, what we have is that there's a lot of strong momentum, right? You can see positive delta, right? There's a lot of aggressive buying into this supply zone, and the volume's also quite high, right? The volume is also quite high, and it's just getting more and more aggressive. But you can see over here, the trading volume is starting to decrease a little bit compared to what we have right here. So there is some sort of supply starting to enter into the market. So to simplify things even further, let me just draw it out for you guys like a quick example. So let's say there's a demand zone right here, and then price is going down, right, to the demand zone, and it has a lot of aggressive selling volume, right? And price is just going down, you know, negative delta, strong amount of volume. There's a lot of orders, a lot of momentum pushing the price down. Eventually, when price get to this demand zone, you realize that it can't seem to break past it multiple times, right? Even though there's a lot of aggressive selling, right? But it can't seem to break past it. This is because there's a lot of demand at this demand zone, and pretty much all the buy limit orders that we have right here is just eating up all the aggressive sell orders, right? It's literally like Pac-Man, right? All the passive limit orders right here, all the buy limit orders right here is eating up all the aggressive sell orders. That is why this demand zone is most likely going to hold and price is going to trade even higher and potentially reverse because of the fact that the buyers are actually took back control of the market at this demand zone just because the passive limit orders was just so overwhelming. So that's essentially what we are trying to do by using the footprint to do, right? So by seeing price actually approach this supply zone that we have right here, we need to see what the volume is actually showing us, right? We need to see whether the aggressive buyers are able to break past this zone. And to do that, it must overwhelm the sell limit orders at this area here. If not, then the supply will come and step into the market and price is just going to reverse and head back down. As simple as that. Now, here's another example. So based on the price action that we can see right here, there's a lot of demand at this area, right? There's pretty much a lot of demand at this area supporting price, right? So this entire area here, there's a lot of demand at this area. So this is the demand zone. And you can see as price comes down into the demand zone, right? We observe the candlestick when it actually reached that point of interest, right? So that is where we really want to focus on the footprint, right? And if you look at this candlestick right here, the one that actually touched into the demand zone, what we have right here was that there was a lot of aggressive selling, right? There's a lot of aggressive selling that results in a negative delta. All right, and if you look at this, there's a lot of trading volume and there's a lot of aggressive selling. But if you look at the buy orders, right, there is 2.462k buy orders, and that completely overwhelmed the 1.381k sell orders. Now, this pretty much tells us that, okay, even though the sellers were aggressive, but then there is so much demand at this demand zone, right? There was so much passive limit orders, buy limit orders, that actually just completely eat up the sell orders that we have right here, which result in price respecting this demand zone, right? And then next thing you know, demand step into the market and push price up, forming this huge bullish candlestick right here. And you can see the delta is a very big number, like a very big positive number, right? And this pretty much just shows us that demand have officially stepped into the market. And quite simply, that's essentially how you actually trade footprint charts, right? You basically just want to wait for a price to get to a point of interest, right? Be it a supply or demand zone, and then to decide whether it's going to respect that supply and demand zone, you go and look at the aggressive selling, aggressive buying, and then figure out who is actually in control of price, right? And just like I said, just because there is aggressive selling doesn't necessarily mean that it's going to break past the demand zone, because the passive buy limit orders can eventually just eat up the aggressive selling and just cause price to reverse. So my advice would be to always start off with the higher time frame, looking at the candlestick chart first to figure out who is actually in control of price, like whether price is bullish or bearish based on the higher time frame narrative, and then as much as possible stick to that bias. So if price is bullish on the 4-hour time frame, you should potentially look for buy orders within the lower time frames, and then you just wait for price to get to some sort of demand zone, right? And then once price get into the demand zone on the lower time frame, you go to your footprint charts and you see that what you want to see is that you want to see buyers take back control of price, right? If price is pulling back to that demand zone, you want to see buyers take back control, and that is when you can potentially enter for your trade, right? So all footprint charts work is that it acts as like an additional signal, right? So at the end of the day, price action, market structure, supply and demand, liquidity, all of these concepts are really what drive the market as well, right? And they are always going to be the core components of my own trading strategy, my own mechanical trading strategy. This order flow, this footprint charts thing is just an additional confluence. Trading plan is what's going to allow you to grow your account, but risk management plan is what's going to allow you to survive in trading. It's what's going to allow you to sustain and play the long game. If you want to trade for a few years, like literally treat trading as seriously as possible and treat it like a business and not just like a hobby, so that the market don't treat you like a joke, you need to practice proper risk management. So the question becomes, what is risk management? So risk management is basically a set of rules you implement to ensure that the impact of being wrong is tolerable. So that is the definition of risk management. And what does it really mean? It basically means that you will lose money in trading. But in order to become consistently profitable, you have to win more than you lose. When you win, you have to win big. When you lose, you have to lose small. And in order for that to happen, you need to make sure that when you lose, you are losing as little money as possible, right? The loss is not so big where, you are literally risking 1/4 of your whole account on one trade. And the thing about risk management is that if there's no risk, there is no reward. No risk, no story, right? To achieve anything successful, like genuinely like great, you need to risk some sort of things, right? And in trading, that is your hard-earned money. And bear in mind that you are a trader, not a gambler. I want to instill this mindset into you guys. You are a trader, not a gambler. Gambler. A gambler is the guy who go to the casino, decide to bet like this amount of money and this amount of money, and then eventually given all in. Let's put all my chips into the poker table or the slot machine. You are a trader. A trader is the guy who take calculated risks. A trader is the guy who knows how to manage his risk so that he can stay in the long term and he can actually make consistent profits. Like I said, this is absolutely essential, all right? It's not, okay, you know what, maybe you don't need risk management. It is essential, right? You need risk management if you want to become profitable. So, risk, the definition of risk is basically the amount of money you are willing to lose for every trade that you take. So, if you have $1,000 in your account and you want to risk $100, then by all means, go ahead, risk $100, and that will be your risk, right? So it's basically the amount of money that you are okay with losing. So in risk management, there is 3 rules that I want you guys to master. We will go through each one of these rules in the following lessons where we talk more about risk management, like leverage, risk per trade, risk to reward ratio, risk capital. All these terms we're going to talk more later. But for now, since this is just like an introduction, you guys must know why risk management is important and how risk management is important, and basically this just shows you, right? So example, the first rule is the maximum loss on a given trade should not exceed 1 to 3%. That is the standard rule. The reason why we keep the maximum loss so low is because if we only risk 1% per trade, we can lose 100 trades in a row before we blow our account, before we lose every single money we have in our account. If we reach 3% per trade, we can take like what? 30 trades before we even, we can lose 30 trades before we can even see our account balance go to 0. So it gives us this large room for error, right? Ensuring that, even if we encounter a losing streak, which is very common by the way, it is okay, right? It is okay. Rule number 2 is to carefully determine your position size based on applied leverage. Right, the second rule of risk management is that you need to make sure that when you are trading, you are using the correct position size. And this depends on your account size, your risk tolerance, your risk per trade, your stop loss distance. All these things determine how wide or how tight your stop loss is. Ideally, we want to have like a tight stop loss, but that cannot be always the case because there's sometimes where we might enter the trade a little bit too late. And then the stop loss distance have to be a little bit wider. In that case, you need to adjust it so that, you know what, it is still low and it actually fits your risk per trade. Don't worry if you still don't get it, I will talk more about this later on what, how, or why, or how do you choose the correct position size when you are trading. Rule number 3 is where we talk about how you need to maintain a consistent risk to reward ratio for all your trades, and it should never ever be 1:1. 100%. It should never ever be 1:1. Because if you're trading, you should want to get back in return at least twice of what you're risking. It doesn't make sense to risk $1 to make $1. Then why would you even risk in the first place? It's counted as a risk because you're expecting something higher in return. So
1:1 is a no-go, at least risk 1:2. Once again, I'll talk more about all of these rules in detail later. But for now, you guys understood why risk management is important. It's because you need it to survive in this market. You need it if you want to trade for the long term and actually, become a full-time trader. You need to preserve your capital in order for that to happen. Because imagine you start off trading with $100,000. That's all your money. That's all your life savings, and you jump into trading full-time with 100K, and you start taking trades. Boom, 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 and you risk 10% on each trade. Boom, 10%, 10K. And you lost that trade. Then you risk another 10%, boom, 10K, and you lost another trade. And then you keep on doing this until you eventually lose 100% of your capital. And guess what? Now you're broke. You have no money to trade with anymore, and now you have to go get a job at McDonald's or some shit just so that you can raise capital again so they can trade again, right? And it all comes down to risk management. If you practice proper risk management in the first place, you risk 1% instead of 10%, then you lose, 10 trades in a row? You only risk 10%. I mean, you only lose 10%, which is okay, right? It's still easy, or rather doable, to earn back that 10% and eventually grow your account, right? So bear in mind that no risk, no story. Once again, these are the 3 rules that you guys should really take into account of when crafting your risk management plan. And this whole syllabus right here, risk mitigation framework, is where I give you the details you need to know in terms of how to manage risk when you are trading. And your job is to go create a risk management plan out of these rules, right? Have strict rules where, you must obey these risk management rules when you are trading. Because if you have rules and you trade based on your rules, your trading will be less emotion based, and it'll be much more rules based, where it's much more rational and logical. So that is generally how you can use risk management to your advantage. Okay, so I'm gonna share with you guys everything on the whiteboard so that it's much more easier for you guys to understand. So the first thing I really want to talk about is what we call your risk capital. Now, what is risk capital? Risk capital is basically the amount of money that you are putting into your account, right? Your trading account, your live trading account. And you can see risk capital can depend on, it's different for everybody, right? Like, I might be okay to put 100K into my live account, right? 6 figures into my live account. But you might have less than $1,000 in your bank account, and then in that case, you might only want to put in like $100 into your live account, right? So it's really different for everybody. And the main concept on risk capital is you should only be putting money that you can afford to lose. That's it. You should only be depositing money that you can afford to lose into your account, into your live trading account. I want you to go into this mindset where whatever money that you deposit into your account balance, treat it as you just lost that money. It's no longer yours. And when you do this, right, this gives you what we call a detachment, right? What we call a detachment, where you are no longer like constantly worrying about the money, like paying bills and paying for food, because this money here is just like disposable income. It's not your life savings. It's not the money that you need to depend on in order to live, in order to survive, right? Because this is just disposable income. So for example, let's say you have $5,000 in your account, even though like most people don't even have $5,000 in your account. But let's say that you are somewhat like have a stable job and stuff, and you've managed to save up like $5,000. $5,000, you shouldn't be putting all of these $5,000 into your live account. I did this last time where I would only have like $500 in my account, and then I'll deposit all of it inside my live trading account. And when I do that, I start taking trades, and every single trade I take, my heart started beating faster and faster, because if I lose this trade, I am literally going to be broke soon, right? And I was risking like what, $20 or even $50 on each trade, and I lost like 10 trades in a row, and I just blew my $500 account, and I have $0 in my live account. I also have $0 in my bank account. That was the worst part. So generally, let's just go back to this, right? You don't want to put 100% of your money from your bank account into your trading account. That means it shouldn't be 100%, right? Right, what's a good range? I cannot really tell you the exact amount or a good range, a good percentage to put inside a live account because I'm not a financial advisor here. But if you really want to, it should be no more than 10%, honestly. No more than 10%. So if $5,000 and 10% is probably like what, $500? Yep. You should only be putting $500 into your account. Right? That is my rule of thumb, right? Because this is a good percentage where you won't feel so attached to the money. So the other 90% right here, right, which is what, 4.5k, right? 4.5k. This amount of money you can use to, you know, go pay your monthly expenses, your transport, food, put food on the table, pay your phone bills, all these things. You need this money, all right? You need this money. That is why when people ask me whether they should quit their job to trade, I would literally never advise them to quit their job to trade. Like, genuinely, you should have some sort of like income on the side when you are trading. When you're just starting out and you're not profitable yet, you shouldn't just solely depend on trading. You need to have some sort of income. So in that case, the risk capital here we had was $500, and it was 10% of our total money that we have in our account. So this was the total capital, and this is what we call the risk capital, right? So this is the amount of money that you're gonna put inside a live trading account. So like I said, I genuinely would not recommend you to put more than 10% into your live account, because the thing about trading live is that the first few times that you trade live, you will lose money, right? You will lose money, and you might even blow accounts. I myself, I blew my first account and I deposited more money into my second account, and I blew my second account and I deposited more money into my third account, and just went on and on like this. And I just, you know, just keep on losing every single cent that I have in my bank account, and I just don't want that to happen to you guys, right? It's a very like depressing state where you have $100 in your bank account and you lose the $100, and then you have to wait until next month. Then you get your monthly allowance from your parents, which is another $100, and then you lose it again and again and again and again and again. It's absolutely the worst feeling ever, and I don't wish it on my worst enemy. And just don't, guys. Just don't. Right? Just practice this rule, and you'll be fine when it comes to risk capital. Now, the next concept I want to talk about is actually what we call the risk per trade. Right? Risk per trade is basically how much money that you are willing to risk on each trade. How much money are you willing to lose on every single trade? To show you an example of how all this risk per trade stuff works, let me just draw it out for you guys to see. Let's say I got a chart right here, right? Go away, Miro. And then let's say price is at, you know, consolidating right here, and it's at this support level right here, right? There's a support level right here. Now, at this point of time, you enter for a buy somewhere right around here, okay? You enter for a buy right here, and you probably have like your stop loss down here below this support level here. And then our take profit could be all the way up at the next, you know, key level or Fibonacci extension level. So all the way up here. So this is your stop loss, and this is your take profit. In this case, your risk per trade is basically the amount of money that you will lose if price goes down and hit your stop loss. Okay, so if your risk per trade is, let's say, $10, right? You need to make sure that the lot size that you're using right here for this buy position, for this long position, correlates to this $10. So if you hit your stop loss, the maximum amount of money you will be losing is only $10. Right? It's only $10. And then in this case, let's say that we have a 1:3 risk to reward ratio, right? Which means that if you lose, you are losing like 1% of your capital, which is $10, right? And then if you actually win this trade and price goes up there, hit your take profit, you'll win about $30. 1:3, right? Risking 1% to make 10%, risking $10 to make $30. In this case, this is your risk per trade, where you are thinking about how much money that you are risking on each trade and how much money you will lose if price do not go as planned. That is basically the whole concept of risk per trade. And the reason why risk per trade is so important is because If your risk per trade is way too big, you will blow your account and you will lose a lot of money and you will never become profitable. As scary as that sounds, but that is the truth. Let me just sketch it out for you guys to see. So let's say you have $100 in your bank account. I mean, not your bank account, your live trading account. And you risk about 10% on each trade. So risking about 10% on each trade means what? You are risking $10 on each trade. Okay? $10 on each trade. Everything is good and stuff. So you actually start off with $100 and then let's say you lose your first trade and then you lose 10%. So now your $100 has just cut off down to $90. Okay? $90. $90. And then you lose another trade and now you're cut down to $80. Right? Cut down to $80. $10. And actually, wait, no, it doesn't work this way. If you are sticking to the 10% rule and you lose your first trade, right? Let's say you lose your first trade, you lose $10. Okay, you lose $10. So the original balance was $100 and you lose your first trade, 10% is $10. And then now you adjust this 10% to this new account balance, which is $90, and 10% of $90 is what? $9. Okay, so you lose another $9. So in that case, you are down to $81. And this just keep on going and going and going, where you are losing $8.1, and just slowly you watch your account. What is this? $8.1, $81. I can't do math. 91.83. Oh my god. My mind literally can't think. It's been so long since I do math, bro. 7. 3. $73.1. Oh my god, it took me so long to do this basic math. God damn it. Yes, and $3.1. And you can see, right, if you lose like, let's say 10 trades in a row, right, you'll probably be down to $0 or something like that, right? 11 trades or 12 trades in a row, and you'll be down to $0. That is why risk per trade is so goddamn important, right? You need to make sure that, you have much more room for error, right? You need to make sure that you have room for error so that even if you lose multiple trades in a row, even if you encounter a losing streak, which is so goddamn common, you will still have money that you can trade with, right? The last thing you should be doing is this. This is a negative scenario. This is a very bad example. Now let me show another example where same scenario right here. You lost, let's say you lost 10 trades, right? You lost 10 trades in a row, right? So another scenario right here where we, instead of risking 10% per trade, we are risking only 1% per trade. So every time you lose $100, you are losing what? $1, right? $1. In this case, you lost 10 trades. After you lost 10 trades, you will be down $10 or something like that, around $10. And in this case, right, guess what? Both guys, both trader A and trader B, they both lost 10 trades in a row. But trader A have $90 left in his account to trade, while trader B has $0 goddamn dollars in his account. So in this example, I literally have shown you guys how important risk per trade is. If you practice proper risk per trade, you will have enough money to trade with. Our goal as traders is not to look at the upside. It's never to look at the upside and how much money that we can make. It's always to look at the downside, which is how much money we can lose. If you trade with this mindset, you will become profitable. If you stop focusing on the money and how much money you can potentially make, right, and actually start thinking about, oh, if this trade does not go as planned, how much money will I lose? If you genuinely start trading with this mindset, right, you will start to, take trades with much more caution, and instead of taking those impulse trades where, you get in and use a position size that is way too big for your account because you are a bit greedy and you want to see how much money you can make on this trade. Oh, if I make this one trade and I win this trade, I'll make like $1,000 in my bank account. That shouldn't be the mindset when it comes to trading. So what is the general rules for risk per trade? Did I even mention about the general rule about risk per trade? I hope so, right? Basically, the general rule about risk per trade is to risk about, oops, not this pen, is to risk about 2% to 3% of your total capital. 1% to 3% actually. The minimum can be 1% to 3%. Right, the reason why we choose this risk per trade is because it's not too low and it's also not too big. And it's just nice. It's a very sweet spot where if you risk 2% on each trade, you can lose like 50 trades in a row, then you blow your account. If you use 3%, you can lose like 30 trades in a row before blowing your account. You can see, you can have so much more room for error where you can lose a lot more money and you'll still be good, right? Still be good if you have a proper risk to reward ratio, which is the next thing we're going to discuss. But for now, just understand this, right? If you can lose less and make more, then obviously you're going to become profitable, right? This is common sense. But why are 90% of traders not profitable? Even though it's a common sense thing to do, that you need to win more money than you lose. It's because of this thing right here. It's because of this thing right here. We don't practice proper risk management. These 90% of traders that lose don't practice proper risk management. So stick to this rule, 2% to 3%. So if you have $1,000 in your account, you should only be risking $20 on each trade, right? If you're $20 to $30 on each trade. So risk 2% to 3% of your total capital, your risk capital, and you'll be good. So in this lesson, we're going to talk about risk to reward ratio. And the thing about risk to reward ratio is basically how much you are risking and how much you are getting back in return is this ratio right here. So if your risk to reward ratio is 1:3, that means you are risking 1% to make back 3%, right? So if you lose this trade, you'll lose 1%. If you win this trade, you will win 3% for your total capital, right? So that is basically the premise of risk to reward ratio. And the rule is that we never ever want to trade with a risk to reward ratio of 1:1 or less, right? Never ever trade with a 1:1 risk to reward ratio. Just think about how stupid that is. You enter for a sell here. Okay, wait, actually let's just use this example, use this chart, right? You enter for us, let's say you enter for a sell right here. Your stop loss right here, above this, and your take profit right here. In this case, 1:1 risk to reward ratio. You risk probably about $10 on this trade because your account only have like what, $100 or something. No, $1,000. So you use 1% on this trade, $10, and you make back another $10 right here. In that case, that is absolutely stupid, because why would you take the trade to make back something that is equivalent to your risk? You always want to make sure that your reward is bigger than your risk, right? That's literally the least you can do. And that is how you can really become profitable, if you can stick to this risk to reward ratio. And that is why the minimum risk to reward ratio I would advise you guys to look for is 1:3, right? 1:3. That means in that case, you are risking 1% right here to make back 3%. You can see, risking 1% to make back 3%, and it gives you a 1:3 risk reward ratio. So in this case, if you risk $10 here, you lose $10. But if you win $30. So that should be the minimum, right? That should be the criteria, the standard when it comes to risk to reward ratio. For me, I like 1:3, but for you, you might be going with 1:2. And the thing about risk to reward ratio, it kind of depends on your win rate. If your trading strategy have a higher win rate of like, let's say 80%, then in that case, you can have a lower risk to reward ratio. And if you have a minimum of 1:2, that means you need to have a higher win rate now. So that means your strategy must win more trades, if that makes sense. So let's just quickly go through risk to reward ratio and why it's so goddamn important. So let's say I enter for a buy right here, right? Maybe I enter for a buy right here. I saw there was some sort of support area here, right? Support area right here, and then I went down to the smaller time frames right here. Let's say I go down to the smaller time frame, and then I entered for a buy right here at this support area. Let's just pretend I'm a retail trader. So I entered for this buy position right here at this support area right here, and then my take profit was all the way up at this resistance area right here. You can see there's a little resistance area right here. So I placed my take profit all the way up here. In this case, this is a place stop loss below this support level right here. In this case, this is like about a 1:4 risk to reward ratio. So if I win this trade, I win 4%. If I lose this trade, I only lose about 1%. So let's just assume that our account balance have $1,000 in our account. And then we are risking 1%. I mean, no, we are risking 2%, right? Our risk per trade is 2%, the standard 2% per trade. And in this case, the risk to reward ratio is 1:3. In this case right here, you're risking 2% per trade, and 1 here means 1 unit, right? So in this case, you are actually risking 2% to make back 6%, right? 1:3 risk to reward ratio, guys. So this is a 2% risk, and this is a 6% reward, right? Very, very simple concept. So far, so good, right? We are risking 2% right here to make back 6%. So if I lose this trade, right? God forbid I lose this trade, I will lose about $20 on this trade. If I win, I'll win about $60 on this trade. Right? Sounds fair, right? If we lose, we will lose about $20, and if we win, we will win about $60 on this trade. In that case, I'm perfectly okay, right? That is okay, and I'll take this trade. But, let's say you were a little bit late. You did not got this entry right here. This is really like the best entry. No, actually the best entry will be all the way down here, and you can see it's like an insane 1:15 risk to reward ratio. But let's say you don't get the best entry. Instead of entering right here, you actually enter a little bit late, right? You open the charts, you just wake up and you already see price up here, but still you feel the need to, you know, enter this trade. You feel like FOMO, so you enter right here. In that case, if you enter right here, where should your stop loss be? You should always be placing your stop loss based on the market structure, right? So you place it below this support area right here, right? It's the same thing, placing it below this support area right here. And then you take profit, where should it be? Same area, this resistance area right here. So in this case, right, in this case, you can see this is actually like a 1:1 risk to reward ratio. And I will not take that trade. I will not take this trade. I'll tell myself, you know, the bus has already went. You've already missed this opportunity. It's already too late. You should not be entering for this trade now. Now, in that case, what's the proper risk to reward ratio that you should aim for? Like I said, 1:3. 1:3. The minimum is 1:2, right? That's the minimum. Less than that is just absolutely no go, right? So another example, let's say I actually managed to, you know, enter on this pullback right here. So enter for a short position right here, somewhere right around here, place my stop loss above this resistance area right here, and take profit all the way down at this area right here. And actually maybe I entered like somewhere right around here. I entered somewhere right around here where there was a 1:2 risk to reward ratio. In that case, when I say aim for 1:3, right, that is somewhat like the scenario where it's perfect, right? 1:3, higher than 1:3 is perfect, right? That means you're risking a very small amount of money to make a lot of money. 1:10, that is absolutely best, right? The higher the better. But let's say we saw this opportunity right here. Maybe right here, we saw all the confluences in the world line up, right? You can see the light bulb in your head lighting up, telling you should enter for this trade because you have all the confluences in the world. Oh, you have this candlestick pattern, price at this zone, order block here, and then supply demand here, Fibonacci here. You get all the confluences, all the signals from the market telling you that you should enter for this trade, right? So this is a trade that you can be very confident on. But I don't have a risk to reward ratio of 1:3. I only have 1:2 right here. The question becomes, will I still take this trade? Right? I get this question a lot. Will you still take this trade if it's less than your risk to reward ratio, but it's a very high quality trade setup, right? It's a setup where, you know, there's a very high chance that price will go in that way. In that case, yes, I will do it. But if same exact scenario, you have all the confluences in the world, and you have all the signals telling you that you should enter for this trade, but instead of 1:2, it's actually 1:1. Will I still take this trade? The answer is no, right? The answer is no. So that is basically the concept I want to drill into you guys for risk to reward ratio, is to make sure you aim for 1:3, right? At least 1:3. That is a very good range, right? That means you can, lose 3 trades in a row, and you just need to win one. Guess what? You will end off as break even, right? You will end off as break even, and it's very common to lose 3 trades in a row. So you just need to win one and you're break even. How beautiful is that? That is why you guys need to have a proper risk to reward ratio. Because if you have a 1:1 risk to reward ratio, once again, right? You lose 1 trade, and then you lose another trade, and then you lose another trade. Now in this case, right, you need to win back 3 trades in order to break even. You can see it's a little bit different now, right? Just now, you can literally lose 3 trades in a row, win one, and you're break even. Now you lose 3 trades in a row once again, but you need to win 3 trades in order to break even. It becomes much more harder to grow your account right now because you are not focused on preserving your capital. So take into account this risk to reward ratio, follow this strictly, and you will have a much more higher chance of becoming profitable. Maximum account exposure. Quite simply put, it's basically your drawdown, right? It's basically your drawdown. You know how when you enter a trade, right? Let's say, once again, this is a chart right here. And let's say you enter for a buy position at this support level right here, right? You enter for a buy right here, enter for a buy right here. And price actually end up going against you for a little bit, right? Going against you a little bit. And you will start to see your account balance. -$10, -$20. You can see the loss starts to get bigger and bigger, right? And that's the floating loss, right? The floating loss, where is basically what we call the drawdown. It's not realized yet. It's not closed yet. If you close the trade at -$20, then that is realized. Then that is your close loss, your realized loss. But in that case, if it's floating like this in your account balance, you can see on your MetaTrader 4 at the top right, it's showing you red color, negative this amount. That is what we call the drawdown. In this case, what should your maximum account exposure be limited to? What's the max amount of money that you should be allowed inside your drawdown? 5%. Generally, 5%. That is my rule. So let's say you stick to the rule of risking 2% on each trade. In order to get a max drawdown of 5%, at all times, right, you should only be having like 2-3 trades open that is risking 2%, right? 2%. Let's say you have 3 trades, right? 3 trades, and all of which is risking 2%. In that case, your drawdown, the maximum is 6%, right? The maximum is 6%, where you actually all your trades hit stop loss and you lose 6%. But in that case, the drawdown should only be 5%, like the maximum. If it's a little bit confusing for you guys, let me simplify it even further, right? Basically, drawdown right here, just remember, the maximum is 5%, right? That's the maximum. And in that case, if you know that you're going to risk 2% on each trade, you shouldn't have more than 2 trades open inside your account, right? You shouldn't have more than 2 trades open inside your account. So, what that means is that 2%, let's say I open 1 trade on a long position, risking 2% on this trade, okay, this exact trade right here, and I bought in for GBUSD, right? GBUSD. So this is my first trade. This is my first trade right here. Then my second trade, I saw an opportunity for me to scale in for this position, right? I start seeing price reverse right now. Actually, no, it didn't reverse, right? Actually, price is continue going down, but I'm still so confident that, you know what, price is going to go up. And right now, price is at a discount, right? Price is cheap. So buy low, sell high, right? So I should enter for another buy. So this was my first buy position, and I entered for another buy right here. But then price just keeps going down, keeps going down. And at that point of time, on the second trade, you risk another 2%. I'm trying to find a way to articulate my thoughts properly, and I'm trying my best here, guys. But I find another way to, risk another 2% on this trade right here. So in total, we are risking 4% right here. Total 4% on this GBP/USD trade. So the worst case scenario is that if we risk, or rather lose both trades, we will be down 4%. That's the worst case scenario. But right now, price is just going against us. You haven't hit our stop loss yet, because my stop loss could be like right here. It haven't hit our stop loss yet. It's just going against us right now and started retracing a little bit and then go down even further like this, right? In that case, my account is in drawdown right now, right? My account is in drawdown right now, and it could be negative 3.5% or what right now. Whatever it is, the drawdown is the floating loss, right? We don't know what it is because we don't know the exact price, but this is the floating loss, and it's not realized yet. Until price hits your stop loss, this is just floating loss, right? Until price hits your stop loss or you close the position, then the loss will be realized, which is negative 4%. So when I say that your maximum drawdown, your maximum account exposure should not exceed more than 5%, what I mean by that is that the amount of open positions that you have, right, and you add up all the drawdown, if the trade does not go as planned, add up all the drawdown, it should not be more than 5%, right? It should not be more than 5%. So if you use the 2% rule, at any point of time, you should have no more than 2 open positions at once, right? So stick to this rule. If your maximum account exposure is 5% and you're risking 2% on each trade, at no point of time you should have more than 2 positions that is open at once, right? So if you enter for the first trade and you do decide to scale in for another trade right here, so you have another trade right here, you have 2 trades running to your take profit or stop loss or whatever right now, right? You shouldn't open a third trade. You should limit yourself to those 2 trades. You need to practice self-control and limit yourself to 2 trades just so that you can stick to this maximum account exposure right here. So next, I'm going to talk about position sizing. So when it comes to position sizing, there is actually 3 factors that you guys need to take into account of, right? And the premise is basically, a lot of you guys don't know what's the correct lot size to use for your trades, right? And it's very important because if you use a lot size that is way too big for your account, you will ruin your account. If you use a lot size that is way too small for your account, you will not grow your account. And I always say that you need to use the correct position size, because if you can do that, then you have an ideal scenario where you can have what I call a big win, right? Your big win. Let me tell you something. Your trade should always only end up in 4 ways. I mean 3 ways. Wait, 4 ways. Okay, your trade will end up in 4 ways. Big win, small loss. But it should never ever be a big loss. And we do that by adjusting our position size, right? So that we can get a big win and also we can get a small loss, right? So once again, comes down to 3 factors right here. So to answer the question, what is the correct lot size that you should be using on each trade, you need to take into account these 3 factors here. Let's go through one by one. So we know the risk capital is basically how much money you have inside your account balance, right? It could be $1,000 or $500 or $10,000. How much money you have inside your trading account, that is your risk capital. Next, we talk about how risk per trade. We should risk about 2% to 3% per trade. For this scenario here, let's just stick to 2%, right? Stick to 2%, that's my standard. Now, the stop loss distance. This is something that is a little bit tricky because we don't have like a fixed predetermined number of pips for our stop loss. And that is another point I want to say. You should never ever want to go into trading with the mindset that, you know what, you always want to make sure that you get the tightest stop loss and have like a 5 pip stop loss every single time. That is extremely unrealistic, and that is extremely stupid and a very dumb way to trade. If you go into this mindset where every single trade that you take need to have a 5 pip stop loss, right, you will end up taking very bad trades. Trades that are not really profitable. That is why you need to place your stop loss based on market structure and place it at a level where it will invalidate the setup if it is wrong, right? If the trade setup is wrong, it will invalidate the setup. So we know that in an uptrend, right, price creating higher highs and higher lows, right, you should be placing your stop loss at all these higher lows right here, a few pips below these higher lows. And if you are trading some sort of order blocks or supply and demand or support and resistance, right, and you actually, let's say, buy at this demand area right here, right, this key level here, stop loss will be below this key level. And same thing over here that we have right here. If you sell at the resistance right here, your stop loss should be above this resistance, right? So that is your stop loss distance. And by the way, this works for supply and demand, order blocks, support and resistance, whatever that involve like key levels or zones that institutions are entering for the trade. Place your stop loss above or below that zone, depending on whether you buy or sell, and then place it like a few pips above or below it, right? If you don't understand where to place your stop loss, then you should go watch the videos where I talk about trading strategies and actually like trading. This is a risk management course, so I'm not going to dive into where to place your stop loss. But if you still don't have a clear understanding of that, go watch the trading videos. So, position sizing. In order to choose the correct lot size, you need to take into account these three things. And a stop loss distance, and it could be like a certain amount of pips, like 30 pips or even 50 pips, right? Depending on how wide is your stop loss and what type of trading style you are. Maybe you are a scalper. A scalper will probably have like a 5 pip stop loss, like a very tight stop loss. But then intraday trader or swing trader might have a 30 pip stop loss, which is much more wider, right? So now, before you enter for the trade, I want you to do this one thing to determine what lot size you should use. And that is to go and calculate what is the correct position size you should be using. Let me give you an example. So let's just go to the charts and I can just give you, let's say we buy at this support area right here, right? And then we aim for this little area that we have right here, this resistance zone right here. And then we place our stop loss below this support area right here. Now, before you enter for this trade, right, there is two criteria that must be met, or what are the two things that you must do. The first thing is to, do this forecast where you place your stop loss and you place your take profit to see your risk to reward ratio. If it's more than 2, then by all means, go ahead and take that trade. If it's less than 2, do not take that trade. Second thing you need to do after you do this is to go and calculate what position size you should be using. So in this scenario right here, let's have an example where, once again, we have $1,000 in our account, right? $1,000 in our account. And then we are risking 2%, right? 2% risk, and that gives us $20. That means we are risking $20 on each trade, right? The 2% risk per trade. Now, in that case, our stop loss distance here is 11.6 pips, right? 11 pips stop loss. So I'm just going to put 11 pips stop loss. We actually should round up, right? Always make sure you round up. So 11.6, you can round up or you can just put in the exact number, but I like to like round up so that it's like a nice whole number. So 12 pips stop loss, and this will be, the stop loss distance. The stop loss is 12 pips. So these are the three information that you need to input inside your position size calculator. And that is where you will find what lot size you should be using. So if you just go to Google and search position size calculator, right? And I would recommend you guys to use the first one right here. This is actually the one that I use by my FX book. So you click on right here and you'll come to this page right here. And like I said, just now, the reason why I asked you to input this information right here is because you need this information so that you can actually determine what's the correct lot size you should be using. So let's just input it. Account balance is $1,000. Account size is $1,000. So that's 1,000. And also make sure you choose the currency pair that you're trading. In that case, you are trading AUD USD, right? And then this account currency is basically the currency that your account is on. Is it on USD, AUD USD, or what? No, but default should be US dollar. And the risk to reward ratio, this is not your risk to reward ratio. This is your risk per trade percentage. So if you are risking 2%, on each trade, your risk per trade is 2%, then here just put 2. As simple as that. Just put 2. If you're risking 3% per trade, then put 3. As simple as that. So in this case, we are risking 2% per trade. And what's the stop loss that we have right here? We have a 12 pip stop loss, right? You can see this is a 12 pip stop loss. And we made sure that we place it at a level where, if the trade does not go as planned, and it actually goes down here, we minimize our loss at a price where it would actually invalidate this setup, right? Because if price actually reverse and go back down, right, this shows us that, maybe price will break through this support area and, it's not going to go up anymore, right? It's not going to respect this support area anymore. So this was a trade that is going to be lost anyways. So 12 pip stop loss, and just put it in right here. Press calculate. And there you have it. As simple as that. This is the lot size that you should be using. So at this point of time, after I get this figure here, I will go on to my position size calculator and just type in 0.17 and then I'll place the buy order. And ladies and gentlemen, that is how you calculate the correct lot size per trade. Let me give you guys another example in case you guys don't understand. Maybe let's just go to USD JPY, right? A yen pair. So in this case, right, let's say you enter for a buy right here at this higher low right here. You can see where's the buy to right here, and I place my stop loss below this last higher low right here and take profit all the way up at this resistance area that we have right here. Right here. Yep, so in this case you can see this is like almost a 1:2 risk to reward ratio. And in this case, let's have another example where maybe we are risking our account balance is $5,000 and our risk per trade is about 3%. Let's say this time around we risk 3% on each trade. And this case, our stop loss distance is what? 33 pips. You can see right here, 33 pips. So stop loss is 33 pips. Now, this is literally all the information you need. Once you get all this information, just go to position size calculator and choose the currency pair, which in this case is USD JPY. And then account size is $5,000 this time. And the risk to reward ratio is 3%, right? Just 3% right here. And then the stop loss is 33 pips. And just press the calculate. 0.68. This is the lot size you should be using for this trade right here. So we'll go on to MetaTrader 4 and actually input the lot size as 0.68. As simple as that. As simple as that, right? By doing this, you are able to ensure that you use the correct lot size while respecting your risk per trade. And I can't emphasize how important this is. Like, it is absolutely essential that you make sure you do this. You do this before you take the trade. No matter how how good the trading opportunity is, you should not be the case where you enter, like let's say on this trade you enter a one lot size, right? Because you saw this impulse move and you start feeling this fear of missing out, and you immediately go on to your MetaTrader 4, press USD JPY, enter for a buy, and you don't know what lot size to use, but you just say, okay, you know what? This is a confirm win one. You confirm a win this trade one, so I'm gonna enter a big lot size, one lot size, and boom, enter for the trade. That is the wrong way to trade. You need to do this thing before you take the trade, right? Calculate the correct position size first, and then enter for the trade. If you can do this, I can guarantee you that you will be profitable. If you can practice or rather apply everything that I'm talking about in this risk management framework, this risk mitigation framework course, and you actually apply it, I can guarantee you that you will become profitable. Alright, so before you do anything, before you take that trade, make sure you go to this position size calculator and just input the information so that they can just do the job, and they can see it's so easy, right? Just one button, and this probably will take you only about like what, 10 seconds or even 15 seconds. Okay, less than 1 minute, alright? It takes you less than 1 minute to save you hundreds of dollars or even thousands of dollars. So do it, and just don't trade based on impulse, alright? Trade based on rational logical. Just trade based on rational and logical, and just use this calculator here. Now let's talk about how leverage works next. So firstly, what is leverage? Basically, let's say you have $1,000 in your account, and then when you sign up for a live account or a demo account even, right, the broker will allow you to choose what is your preferred leverage, right? There's usually options ranging from 1:20, 1:50, and then there's even 1:100, right? Basically, the broker will allow you to choose which leverage do you want. Now, let's say you choose 1:100. That's the leverage they will choose. And remember, you have $1,000 in your account. So if you have a leverage of 100, that means 100 times $1,000, and this means that you have a buying or selling power of $100,000. Right, so essentially this leverage is acting as somewhat of like a borrowed capital that allows you to make more money by trading with a bigger account size, or rather like a bigger lot size. That's what I mean. And is a double-edged sword, right? Leverage is a double-edged sword. It can increase your wins. It can also increase your loss. Right? It's a double-edged sword. That is why you want to make sure that when you're choosing what is the correct leverage to use, or rather what leverage that you want to use, it's not way too high. It's not too ridiculous, right? And my honest opinion would be to just stick with 1:50 and not go any higher than 1:100, right? 1:100 is the max, right? Because if you go up to more than 1:100, where you even go to like 1:500, 1:1000, right? First of all, those brokers that offer such high leverage are most likely unregulated, which means they are not safe, they are not licensed, and they might run away with your hard-earned money. Second of all, it's way too much, right? In that case, you are already over leveraging. You are already, risking too much of your capital, right? And let's say in this case, you decide to go with a 1:100 leverage, and you have a buying or selling power of 100k. What this means is that you can trade up to a standard lot size, which is a 1.0 lot size, right? You can trade up to a standard lot size. That means every time price move by 1 pip, guess what? You are making $10 per pip, right? $10 per pip. But without leverage, let's say you take leverage away and you only have $1,000, and that means you can only trade with $1,000. Right, so you have $1,000, you can trade with $1,000. In that case, do you think you will still be able to use this 1.0 standard lot size? No, because you need 100k inside your account in order to trade one standard lot size. In this case, you can probably only trade like the smallest lot size possible, which is the 0.01 lot size. You can't even trade a mini lot. You can only trade the smallest lot size, which is 0.01 lot size, where you are making literally pennies. Right? You are making literally pennies, 10 cents per pip. This just shows you the power of leverage. With leverage, you are able to trade with bigger lot size. Right? That means that you can have a very small amount of money inside your account and trade with lot size that is bigger than usual because of leverage. That means you're able to risk more money than usual and you can make more money than usual. But bear in mind, like I said, it's a double-edged sword, right? If you want to win more money, that also means that there's a chance that you're going to lose more money. So the thing about leverage is that, honestly, all of this stuff won't matter if you follow your risk management plan. If you strictly follow your risk management plan, then you won't be, going overboard with leverage. You won't over leverage. So let's say you stick to a 1:100 leverage and you have a 100k account, right? If you're calculating your risk per trade, it should not be based on this amount here, right? That means that if you are trading with this account right here, you have $1,000 and you deposit into this broker which offers you 1:100 leverage, that means you can trade up to 100k, right? You should not, let me repeat myself, you should not be calculating your risk per trade based on this amount here. Your risk per trade should be based on this amount right here, which is what you have inside your account. Because just now I talked about how risk per trade is a percentage of your risk capital. In this case, this is your risk capital right here. Right? This is your risk capital. And this is just imaginary. Right? Let's just imagine this is like a imaginary risk capital plus borrowed capital from the broker. So 2% risk per trade would still be your $20, right? It will still be $20 on this trade. So leverage doesn't really change your risk management plan. It just amplifies it and give you the ability to trade with more money so that you can grow that small account faster, right? And actually sustain in the game. Now, the next thing I want to discuss, which could be quite useful for you guys, is actually stops and limit orders, right? This is just an additional thing that you guys can, or rather you want to know, then just go ahead. But if you don't, then just continue entering into trades manually, like pressing the buy or sell button manually. But if you want to find a way where it's like automated, that means that if price reach a certain level, your broker will automatically get you into that position, either for a buy or a sell, depending on what limit or what stop order that you use. So that is basically 4 ways where you can automate this process, and that is through buy stop, sell stop, buy limits, and sell limits. Let's go through one by one. So buy stop is where you place a buy order above the current market price. So let me just maybe draw some example for you. Right, let's right here. So let's say price is creating an uptrend, right? Price creating an uptrend, and you want to place a buy stop order right here when price break through this high area. So you'll place a buy stop right here. So right now price is going up and you won't be in the position, alright? You can maybe be at the gym or spending time with your family and you're not looking at the charts. So never mind, go do that because you already place a buy stop order right here. So if price reaches this area, your broker will automatically get you into a buy position, and that is what price did right here. Okay, so right now you're inside the buy position right here, and this is what we call a buy stop, right? This is what we call a buy stop. But in this case, what if we don't want to trade the breakout of this high, right? We want to trade the pullback, right? Oops. So in that case, I want to wait for price to pull back to maybe like right here, somewhere right around here, and then that is when I will enter for a buy position right here. In that case, you can't be using buy stop because buy stop is an order that is placed above where currently the market is at. But right now you want to enter at below where the market is currently at. So in that case, you won't use a buy stop, you will use a buy limit, right? It's basically an order placed below the current market price. So this is below the current market price, so you place a buy limit right here. So once again, price will come back down here. Your broker will get you into a buy position right here at this low point, and yep, just continue to watch your profits skyrocket. Now, on the other hand, let's just switch to maybe a downtrend, right? Maybe not even a downtrend. Let's just use another example of just a consolidation. So there's a resistance area right here. There's a support area right here, or whatever you want to call supply zone or demand zone, all right? So let's say price comes down to this area right here, and it's showing a lot of selling momentum, a lot of liquidity, right? A lot of liquidity. Price is just crashing down a lot, and it's coming down to this area right here. And you are predicting that price is going to pierce past this demand zone, right? It's not going to respect this area right here, and it's just going to crash and just pierce past it. In that case, what you want to do is to place a sell stop, which is an order placed below the current market price, right? So this is the current market price, and this is where you want to enter. So it's actually below the current market price. So you place a sell stop right here. Once again, once price hits this area here, broker will automatically get into a sell position, and yep, that is how it works. But in that case, let's say price decide to reverse at this area here, right? Reverse, creates high highs, high low, high highs. And you actually want to enter for a sell order at this supply zone because you know that there's a lot of sellers waiting at this supply zone, a lot of liquidity to be grabbed right here, right? And you know for a fact that this is a very strong supply zone and price will respect it and reverse at this area. So in that case, you'll place a sell limit, right? Because this is the order and it's placed above where the current market price is, which is right here. So price will go up here, smash your sell limit right here, activated, and that is when you enter for sell position. So this buy stop, sell limit, buy limit can be very useful, especially if you are trading order blocks, right? Or supply and demand zones where you know you want to enter for the trade immediately when price touches that area, right? Immediately when price comes back to touch this order block area, you want to enter for a buy order right here, right? And in that case, which one will you choose? Will you choose a buy stop or buy limit? Obviously, you're going to choose a buy limit because you want to wait for price to come back down here, touches this area, right? And this order is below where the current market price is. So, yep, use this if you want, and I believe that this will be a very useful tool where you can save a lot of time. So what you see on the screen right now is basically how price actually move on a fundamental level. And I know it might look very complex and confusing right now, but don't worry, I'm going to go through step by step and dissect this entire chart diagram for you. So first of all, price in an uptrend, in a bullish order flow, price will go up, right, and reach some sort of unmitigated supply zone, right, which you can find on the higher time frame, and then it will start pulling back. Right, once it starts pulling back, more demand step back into the market to push price up even further, and eventually what happens next? You are just anticipating or rather waiting for price to start pulling back again. So when price actually break above the last swing high, now creating your bullish break of structure, we can expect price to start pulling back, right? So when price does that, eventually come up to some sort of unmitigated supply zone. Once again, you look towards your left, you identify any sort of point of interest, supply zone, order block, or flip zone, whatever. And then your job is to just anticipate a pullback to happen at that point of interest. So that is what it did right here. So once price start pulling back, what you can do is to narrow your focus to a certain part of price so that you don't confuse yourself, right? So you basically do that by actually marking up your strong low and also your wick high right here, which is the highest point before price starts pulling back. And I almost forgot to mention, but for this strategy, we are only going to be using 3 time frames, right? We're going to focus on 3 main time frame: our higher time frame, medium time frame, and lower time frame. The higher time frame, the daily time frame, we're going to use it to actually identify the swing structure to find out whether price is actually bullish or bearish, whether price is in the continuation phase or the pullback phase, and then also identify the swing structure like what we have done here, right? And we are also going to use it to mark up any sort of unmitigated supply or demand zones. So that's the purpose of the higher time frame, is to allow you to build a narrative and actually allow you to understand what's going on with the market right now. And then for the medium time frame, we're going to use the 4-hour or the 1-hour time frame, and this is where you can identify the internal structure, right? What is price doing within this swing range itself? And then you can also mark up any sort of medium time frame point of interest. And then lower time frame, 15-minute time frame or the 5-minute time frame, these are the time frame that we are actually going to be executing our trade on, right? So these are the time frame that you want to look for your entry models. Price is going to turn bearish for a short amount of time to facilitate the pullback of the higher time frame trend, the higher time frame order flow. So that is when price started turning bearish in the internal structure, creating a lower high, lower low, lower high, lower low. Like I said, it's just facilitating the pullback. That is why price is going to turn bearish. And then eventually price pulls back, and it pulls back all the way down to where? Your demand zone that is created from the strong low, right? So this is when price actually pivoted, right, and created your last higher low. So at this last higher low, there's going to be demand, there's going to be buyers waiting for this at this area to actually push price up. So that is when price get to this demand zone, right, this higher time frame demand zone, and at this strong low, that is when we know that this pullback could potentially end soon. And that is when we know that price is going to turn bullish again, right? Shift of structure, shift of order flow, flip from supply to demand, and right now the internal structure is aligned with the external structure, the swing structure, and yeah, basically it's bullish, right? Right now internal structure is bullish, external structure or swing structure is bullish, and right now you can look for price to actually create that higher high and higher low, and most likely you can see price come up to our wick high that we have right here, and then eventually it could break above this wick high, creating your higher highs and higher low break of structure. When that actually happens, this whole cycle repeats itself, right? So this is just how price actually works on a fundamental level. I did not create this. This is just how price actually is. When you look at a chart, right, the main thing you want to ask yourself is who is in control of price, whether the supply or the demand. In this case right here, where price is actually creating that swing structure, demand is in control, right? Price is bullish, demand is in control, and price is just creating this bullish break of structure. But the minute price starts pulling back, right, like I said, it's going to turn bearish for a short amount of time to facilitate that pullback. That is when supply take control of the market. And then eventually price get to some sort of demand zone right here, and then demand step back into the market and take over control of price. And that is when price starts turning bullish again to be aligned with the higher time frame order flow. So yeah, this is the question that you want to ask yourself at all times. Who is in control of price? Because if you can answer that question, you can be on the right side of the market and you can actually win rather than lose your hard-earned money. And now that you have a broad overview of how price actually works, your next question is, okay Brad, cool. Now where exactly do we enter on? How do we actually trade this? Do we enter for a sell right here during the pullback, or do we enter for a buy, say right here at these lows? Or do we enter for a buy here, or do we enter for a sell here? Right, where exactly can we actually trade from? That is when we move on to the next part of this lesson, which is your market phases. Right, you need to understand which phase of the market is it in right now, and then deploy your trading strategy accordingly, right? This means different market phases, you must be doing different things. And this is
the main thing that so many traders get it wrong, right? A lot of traders, what they do is that they try to buy at all these weak lows right here, right? They try to buy at all these weak low right here, right? Which doesn't make sense whatsoever because price is still bearish and it's still pulling back. So if you enter for a buy right here, you are going against the internal structure, the internal range. And then some people, they try to enter for a sell right here, where price has already turned bullish, it's already aligned with the higher time frame order flow, and you're still trying to go against the trend, right? Go against the internal trend and the swing trend, which just doesn't make sense whatsoever. So yeah, now I'm just gonna explain to you how these different market phases actually work. And I mainly split it into 4 phases, right? So let's go through one by one. So firstly, we have the pro swing plus pro internal phase, right? And you can see the color of the phase, it's correlated to the color of the boxes. So you can just match the phase of the market to the color of the box, right? So first phase is the pro swing plus pro internal phase. What this means is that the swing structure, the trend, the order flow is the same as the internal structure, internal order flow, right? So this phase happens when price has finished pulling back, right? It has finished pulling back, and then right now it's continuing with the higher time frame order flow, right? So in this case, your objective is very simple. It's just to ride the higher time frame trend and order flow, right? This means you can look for buy at all these demand zones right here, demand zone, and then after you have entered for buy at these demand zones, at these higher lows, right, you can target these weak swing highs, because this is where price is most likely going to gravitate towards, and it's going to end up breaking past it and create another higher high and higher low, right? So this is one part of it. Another part of it is, if you look towards your left, after price actually create that break of structure, right, before price starts pulling back, you can also look for some buying opportunity right here during this push phase. Now during this push phase, obviously price will not just go up in a straight line like this. You'll most likely do something like this: go up, then come out to our supply zone and start pulling back. So within this push phase, with this minor correction, this minor little pullback, right, you can actually look for a buy position, right? But bear in mind, like I said, it's a very different setup if you are entering for this buy position compared to this buy position, because this is fresh, right? This is just fresh out of oven. Price has just finished pulling back, and right now price is turning bullish to facilitate the higher time frame order flow. But over here, after price created the break of structure, it's most likely going to start pulling back soon. So if you enter for a buy right here, bear in mind that you have to be fast in terms of taking profit, right? You have to get in and get out of fast, because you never ever know when price will start pulling back, when the higher time frame order flow will come up to some sort of unmitigated supply zone and start pulling back. So be careful. And like I said, last thing is this area, right? This phase of the market, this is where you are able to get the most highest probability trade setups, because these are the phases where the internal structure, right, the lower time frame trend is bullish, the medium time frame trend is bullish, the higher time frame trend, higher time frame order flow is also bullish. So you can see everything just align itself like clockwork, baby. So this is really when you can be more confident in terms of the trades that you are taking within these phases. So the next phase is the counter swing plus counter internal phase. This phase is a little bit trickier, because this is where we are going against the higher time frame order flow and the lower time frame order flow and the medium time frame order flow, right? We are going against the trend. We are going against the current of the wave in the ocean, right? But this is also where you are able to capture those high risk to reward ratio trade setups, right? You can enter for a sell here, and then you can target all the way down here at this demand zone. But the difficulty comes when you are trying to predict the top of the market, because it's very, very difficult for you to actually predict the top of the market, right? You never ever know when price will start pushing even higher before it starts pulling back, right? And sure, this higher time frame point of interest give you the extra confluence, but there's always a chance that it's going to pierce past it before it starts pulling back. So this is where you want to look for reversal setups, all right? So ideally, like I said, after price created a break of structure, we are anticipating price to start pulling back, okay? So knowing that, where's price going to pull back? It's going to pull back at some sort of unmitigated supply zone. So the minute price actually reached that unmitigated supply zone, I wouldn't actually recommend you to actually enter for a sell immediately, because like I said, price can always just pierce past it. So what you can do in this case is to wait for your market shift to happen, to wait for that shift of structure to confirm to you that price is turning bearish, to facilitate that pullback.
right? And you will only get that after price create that market shift, right? It gives you the extra confirmation. So I wouldn't recommend you to actually enter for a sell here immediately. Once again, you can do whatever you want, right? If you want to get that sniper entry, you can actually enter here immediately. But like I said, always wait for the extra confluence, and please don't enter immediately if you are a beginner who is not consistently profitable yet whatsoever. Now, when price create a market shift, give off that shift of structure, we have a confirmation that price has officially turned bearish. Now that price turned bearish, when price actually created this market shift, what happened? There was a demand zone right here. Price comes down to this demand zone, created a failed reaction right here. Now when it created this failed reaction, right, it created a flip zone that we have right here. Right, so if this demand zone were to do its job, price were just gonna go up even higher. But no, it created a failed reaction, created a lower high right here, giving us our demand to supply flip zone. Now we got our demand to supply flip zone right there, so that is when we can move on to phase 3. Phase 3 is when you want to look for short-term selling opportunity to ride the pullback, because right now we know that price is turning bearish to facilitate the pullback, so we can actually capitalize on this fact and actually look for sell position at all these highs right here, all these lower highs being formed right here. So your job, your objective for this phase is to just play that pullback, right? Or like I said, if the higher time frame permits, this can even be a reversal, right? This can even be a reversal and price could just go down and crash all the way down and just breaking past the strong low. If not, then price is most likely going to pull back to the demand zone that is at the strong low, where demand will step back into the market and push price up again. So within this phase, like I said, you are looking for quick trades, very fast trade, get in and out fast, right? So short-term selling opportunity, you can sell here at this flip zone, and then price goes down, create another lower high or flip zone, whatever, you can look for another sell position here. And bear in mind, this is very important. When you actually put on your premium and discount matrix, you realize that above this 50% level, this is where price is at premium pricing. So this is where it's optimum for you to actually enter for a sell if you are trading the pullback. And then once price actually get into the discount zone, it's a whole different story, because this is when price will potentially start reversing and go up now, right? Because price is within the discount range, and this is where there's going to be some sort of demand, right? So bear in mind that it's a very different story to actually sell here compared to selling, say, right here, right? Because right here, price has already created a market shift, price has already turned bullish, the internal structure is already bullish, so it doesn't make sense for you to actually enter for a sell right here where the internal structure and the swing structure is both bullish, right? So bear in mind, when it comes to this, be careful, okay? Look for short-term selling opportunity. Like I said, short-term, keyword here is short-term. If you want to enter for a sell here, take profit at this low right here, enter for a sell here, take profit at this low, right? In and out. And then last but not least, my favorite phase to trade is the pro swing plus counter internal phase. This is where you are able to get those high risk to reward ratio trades, and it's actually high probability compared to this one, which is low probability, right? Because this is when you got that swing structure, which is bullish, the internal structure is bearish, but then it is shifting to bullish. So this is basically the start of this continuation phase. So if you're able to get in right here for a buy, guess what? You can capitalize on such a huge move right here, because price is most likely going to go up to the weak high that we have right here. So this is where you are anticipating the end of the swing pullback, right? So this is price pulling back, okay? Price is pulling back, and it's going to pull back to where? Like I said, some sort of demand zone at the last strong low, right? So the minute price actually get here to this zone, this is when you can actually look for that reversal, right? Your reversal setups. And how you do that is to wait for, once again, your market shift to give you a confirmation. There's a shift of structure, this pullback is done, the bears are out, demand has officially stepped back into the market and take control, and then price is going to turn bullish. And then I'll personally enter after that market shift happens, get some sort of liquidity sweep, and then I just wait for price to get to my point of interest being created right here, either a flip zone or an order block or an extreme point of interest. Bam, get my entry, and I trade it all the way up here, right? And yeah, this is basically how you actually trade the markets. So just to show you, this strategy actually works. I'm actually up like 5k using this strategy, right? This is just proof that I'm not just sitting over here and just yapping to you guys about a strategy that haven't been proven whatsoever. Like I said, this actually works, right?
And yeah, you can pretty much see that this is actually the trade that I actually entered on using this mechanical trading strategy. And right now, this is the result, right? Making about 5K right now. So I'm just going to explain the thought process about this trade and how to actually apply this market phases thing towards that trade, right? And like I said, knowledge is absolutely useless if you don't apply it into the market. So let's look at the market and let's try to apply the different market phases. So first of all, right, the first phase is right here. After price created a break of structure, price is bullish, and this is when you can look for, like I said, your short-term buying opportunity, because price is gonna start pulling back soon, and you don't want to get caught in the pullback. So you can actually enter for a buy here, right? There's a demand zone being formed right here. You can easily enter for a buy here or another buy at this area here. But the minute price actually get up to that unmitigated supply zone, you shouldn't be looking for buy whatsoever. So if you enter for a buy right here, guess what? Your take profit will be at this supply zone, right? Very in and out fast. And then also here as well, right, which I'm going to discuss later. And then next, price actually get up to that supply zone. If you look towards your left, right, what do we have here? Supply zone, right? Supply zone. This is where smart money have entered in the past, right? There's a lot of supply step into the market and push price down. So yeah, this is where phase 2 actually happened, right? Supply step back into the market, take control, and price started turning bearish to once again facilitate that swing structural pullback, right? So over here, we got that market shift happen right here after price actually broke through this last low right here, right? Market shift, right? And then over here, there's a little bit of failed reaction before price goes down even lower, creating your lower high and lower low, right? Lower high, lower low. And then in this case, you can actually drop your medium time frame supply zone right here. So if you want to enter for a sell right here, that will be phase 3, right, where you are trading counter swing and pro internal, and this is when you can easily look for some selling opportunity right here. And bear in mind, if you want to enter for a sell here, I will actually recommend you to take quick targets once again, and where you should be targeting is at this swing low right here, right? So this last swing low, right here or here. Or if you want to swing for the fences, right, what you can even do is to just target this strong low that we have right here, right? This would be a very good setup as well, but it won't be the most highest probability, because if you look towards your left, what do we have right here? There is a demand zone right here. So there's always a chance that price will get down to this demand zone, right? Get down to this demand zone, and price will just continue and going up like this, right? So that is why I will ask you, if you are looking for short-term selling opportunity right here, right, you're trading phase 3, be conservative with your take profit and just take profit at the next low, right? And eventually price comes down, right, come back down to our strong low that we have right here. And what do we have? If you look towards your left, this is your order block or demand zone, right? You can see this is actually an order block. If you want to refine it to this candle right here, that would be your order block. And then over here, we got a little bit of liquidity being swept as well, right? Where there's liquidity being built up below these lows, price swept the available liquidity, and bam, that is where demand step back into the market and push price up. So this is a very strong demand zone. This is a very valid point of interest. So we can definitely depend on it, because there was imbalance, there was lots of demand, lots of buying momentum, and price has also swept available liquidity at this strong low, right? So this is when we can look for your phase 4 trades, right? This is where you can anticipate that this pullback could potentially end, and right now price is about to turn bullish to be aligned with my higher time frame order flow, which is bullish, so I can actually enter for a buy somewhere right around here. And then this is where I will be targeting where my weak swing high, right, which is all the way up here, right? So yeah, that is basically how you actually do it. And then later on, price goes up, creating that, what do we have right here? This is actually your market shift, right? This is the last lower high, and over here we got that market shift happen. Just get rid of this. Got a market shift happen right here, and after market shift, price pull back. And then if you notice, what do we have here as well? There's a supply zone right here. Okay, supply zone, and then it created a failed reaction right here. So there's actually a flip zone right here, right? So there's actually a flip zone right here. This is where you can actually look for your entry, right? So first of all, after price created a market shift and price starts pulling back, this could be your first point of entry, right? Somewhere around here, you probably get the lower time frame market shift. You could have entered right here. If not, your second point of entry would have been somewhere right around here, right? Started pulling back to some sort of little demand zone that we have right here, and this could be your second point of entry. And if you miss this setup and this setup, guess what? You're waiting for price to pull back. And where is it going to pull back? It's going to pull back to this flip zone that haven't been mitigated yet,
right? And that is when price come down to this flip zone. This could have been your third point of entry, right? And yeah, that's basically how the different market phases work. And just to quickly explain the trade that I'm in right now, I actually entered during phase 4 and phase 1, right? So this was my first setup. So immediately after price actually created that market shift on the lower time frame, bear in mind this was on like the 1 minute time frame, right? And then price come down to my swing low, right? My valid point of interest, that swept liquidity, my strong order block, right? So price comes down here. That is when I waited for the market shift, waited for liquidity to be swept, right? Got all my confluence, then I enter for my first trade right here, right? So I was actually looking for my second opportunity, but I didn't get any because price was just going up and there was no valid point of interest being created until price actually come up to this supply zone, created a failed reaction like I mentioned just now, creating a flip zone, and bam, I'm just waiting for price to come back down to this flip zone, right? And then eventually price keep on going up, and then right now price has officially pulled back, tapped into that flip zone. That is where I look for my second position, right? So this is where I actually entered for my second trade. So that is why if you look at the MetaTrader 4, I have 2 trades in place running to my overall take profit, which is all the way up here at this little order block right here, right? So yeah, that's basically how I actually trade. Now, to keep things super simple, we are only going to be using 2 time frames. The higher time frame will be our 4-hour time frame, and the lower time frame will be our 15-minute time frame. So the first step is to build your higher time frame narrative. What we are trying to do here is to really come up with a story on what price is actually doing right now, so that we can identify our trade buyers. So the first question you want to ask yourself is price bullish or bearish? So we know that price will not just go up or down in a straight line. If price wants to go up, it will go up, pull back a little bit, and then goes up even higher, pulls back a little bit, and then goes up even higher. That's just how the market works, right? Nothing will ever go up and down straight. I know this might sound super basic, but people need to be reminded more than they need to be taught, right? So in an uptrend, we know that price is going to be creating higher highs and higher lows like what we have on the screen right here. So when price breaks through the last high, it creates what we call a break of structure to the upside, right? So this is our bullish break of structure. So if we were to map this up, we see that price is creating, like I said, higher highs, higher lows, leaving us a bullish break of structure. But we know that price will not go up forever. At some point of time, some sellers will come into the market and overwhelm the buyers. And that is when price will come down there and break past the last higher low. When this happens, this is our market shift. And then this market shift pretty much just tell us that price is reversing from an uptrend to a downtrend, and right now we are about to turn bearish. And if price is turning bearish, price will be creating your lower highs and lower lows, like what we can see on the screen right here, right? You can see lower highs, lower lows. Once again, it's creating bearish break of structure to the downside. And then eventually price will turn back bullish again when demand step into the market and overwhelm the sellers. And that is when we will get another market shift where price break past the last lower high, creating a new higher high. And now we are officially bullish. So this is just how the price move, right? This is just how the market works. That's the first thing you must understand, right? Is to really identify whether price is bullish or bearish right now, because we want to trade with the trend. If price is bullish, ideally we want to buy at all these higher lows. And if price is bearish, we want to sell at these lower highs. I know you're probably sick of hearing me repeat this like 1,000 times by now, but you must make sure you master the basics. Because if you don't, you are essentially building a house on sand. And if some natural disaster comes, it will just come and wipe out the entire house, right? So we need to have a solid foundation. The second question you want to ask yourself is price in the continuation phase or the pullback phase? Because after a break of structure, we know that price is going to start pulling back. And we need to have that at the back of our mind. And a lot of people don't, and a lot of retail traders don't. They assume that after price break through the last high, price is just going to continue going up like this in a straight line, and they start entering for a buy here, buy here, buy here, just for price to start pulling back. And then they are wondering why the market is going against them, so on and so forth. After a break of structure, instead of entering for a buy immediately, remember, we want to wait for price to pull back, and then we will enter for a buy right here. Because if you enter for a buy right here, guess what? Your stop loss must be below this last higher low, and your risk is essentially much higher compared to if you're entering right here and you have your stop loss below this last low. So that's the first step. You identify whether price is bullish or bearish so that you know exactly which side of the market you should be trading with. And then you identify whether price is in the continuation phase or the pullback phase. If price is in the continuation phase, I will advise you to wait for price to start pulling back and start to create that new structure. Then you enter for a buy. Because ideally, you want to trade with the trend after the pullback is over. So for the second step, we are still on the 4-hour time frame, and this is when you want to map out your supply and demand zones. In the last video, we have already taught you how to actually map out your supply and demand zones. And I'm not going to go through the entire thing again, but basically, you want to identify demand zones in a bullish market, and you want to identify supply zones in a bearish market. Because these are the zones that are aligned with our higher time frame trend, and we want to be able to trade with the trend, right? So using this example right here, what we have was that price was going up, and then it hit onto some unmitigated supply zone that we have on the left hand side. And that is when supply stepped into the market, and that caused price to start turning bearish to facilitate the pullback, right? So once price starts pulling back, eventually it goes up there and break past the last high, giving us a break of structure to the upside, and now we know that we are in the continuation phase. Remember, when price is in the continuation phase, yes, you can enter for a buy here and here, but I will advise you to trade after the pullback is over so that you can get the optimum entry point. Eventually, price will start pulling back again. Once again, why is it pulling back? Because it hit some sort of supply zone that we have on the left hand side, and supply stepped into the market and caused price to start turning bearish. Now, once the pullback start happening, you will start to see price creating lower highs and lower lows on the lower time frames. And at this point of time, you must be aware of the higher time frame trend and know that we are just turning bearish for a short amount of time to facilitate the pullback on the higher time frame trend. So you cannot assume that price is reversing into bearish right now because price has not took out this last higher low. That means we are still playing within this swing range right here. This is a swing high, this is a swing low, and price is just turning bearish to facilitate the pullback. So in this case, since we are in a bullish market where price is creating higher highs and higher lows, we want to trade from demand zones, right? So based on this, we are able to identify two demand zones. This is the first demand zone that was being created after price broke structure, and then this is the second demand zone, right, which was created after price broke the internal structure right here on the lower time frame itself. So now our job as professional trader is to simply wait for price to come back down to either one of these demand zones, and then wait for our entry model to present itself, and then that is when we execute our trade without hesitation, reservation, or fear. So now this is where I will advise you to set the alert at the edge of the zone that you want to trade from. And right now you might be